what we saw back here to what we saw back here in 2013, 2012, 2011. We had, this is our record low for soybean ending stocks was back here in the 2013-14 marketing year. And we're about 2.6% carryover, about 3% right now forecasted for old crop. And we're just about, I think it was 3.2% for new crop. So exceptionally tight stocks. As we get these ending stocks numbers smaller, what two things happen? Number one, we tend to have average prices are higher. Average market prices are higher for both futures and cash, but we add a lot of volatility. We're going to see a tremendous amount of movement. And now that the Chicago Board of Trade has extended or expanded their trading limits, the daily trading range, the standard daily trading range for soybeans right now is plus or minus $1 a bushel per day. The extended is even more than that. We've already seen a tremendous amount of volatility. Folks, this is going to be what we're going to see for the rest of the summer. And all of that up until when the combines start running is going to be based on weather and weather forecasts and what we expect yields to be. So our margin for error is exceptionally tight in soybeans. All right, so what does that mean moving forward? One of the other things obviously is the demand side. Now, right now the focus is really on the supply side, not the demand side, but we do need to be thinking about if supplies get exceptionally tight and prices start to go very, very high, who stops using soybeans? Because the whole idea behind higher prices as we move in the marketplace is to start rationing this usage. As our ending stocks get tighter, as the supply chain gets tighter and tighter, prices go higher to try and ration this use, ration the available supplies we have. So my open-ended question, and this again will be debated as we go through the rest of the season, as prices go higher, who starts using less? Who is it that's going to be backing away from the soybean demand side to make these adjustments? Because we're never going to run out of beans. This is the pricing mechanism is going to make sure we have some soybeans left over in the system. It's just a matter of how much and who has to stop using or switch to something else. Now, historically, the exports and the export market has been the area where we've seen the drop off first. Now, I'm not saying that China is going to, dramatically change the way they buy US soybeans. That's pretty unlikely. They might shift things around from a timing standpoint based on, kind of our harvest schedule and the quality of the beans coming out of South America. However, we do have other customers that buy soybeans from us. And some of those countries are also very price sensitive. So we will likely see export pace or export numbers for this new crop marketing year being lower than what we saw last year. Okay, simply because of the timing and our expectations for higher prices and tighter supplies. So as we move through the winter months, as we get into after harvest or post-harvest and what's going to happen there, again, the focus will shift on the demand use and in particular on our export pace and who's buying our soybeans. Yes, China is still going to be our number one customer, but we have other customers and they can adjust their buying habits as well. So right now, embedded in all of these assumptions is we're going to see a lowering, a reduction of our exports, our total US soybean exports, but the crushing demand is forecasted to continue along its nice steady growth forward. Okay, so we need to separate out who's buying soybeans and how much they can afford to pay. All right, let's dive. And I don't want to go in, I know Mark Ewan is going to do an exceptional job talking about the weather and forecasting the weather, but I do want to talk a little bit about the drought monitor because this is a great tool. There's a lot of market analysts and traders, whether they're really into the ag markets or not, whether they're kind of a passive trader or like some of the managed hedge funds where they're following this, but they're really not an ag kind of trader. This is information that impacts the marketplace. I know there's kind of some debate on how accurate this is and what the implications are. Just as a very quick reminder, these different color codes, the D0, the D1, the D2, the D3, the D4, those different color bands, the simplest way, at least the way I have found that makes the most sense, is you're trying to determine how deep in the soil layer has that dry zone fallen. So if you're in a D0, it's saying, yeah, the surface moisture is getting kind of dry. By the time you get to a D2, that dry layer in the soil profile has gotten deeper and deeper. By the time you get to a D3 or D4, you've got serious problems. You know, you've got stock ponds that are dry, you've got irrigation wells or water wells that are starting to go dry. That soil moisture layer has gotten, the dry layer has gone deeper and deeper into the soil profile. So not only do we need to think about what does the soil profile look like, and is there some soil reserves we can draw upon if there's some rain showers that are missed, but we also have to look at surface moisture, because again, if and most of you as farmers know this, even though you might have some dry conditions, if you get a shot of rain at the right time, you know, that can make or break your crop. So it's not always about how dry the soil lower profile is itself, but also when do you get rain showers and what's happening within the root zone. So this is important. This is information that the market traders and analysts use. This map influences market psychology. You do have to pay attention to it, whether you agree or disagree with the accuracy or agree or disagree with how people are using it. This is still impacting people's behavior. So we need to pay attention to it. Now, one of the things that USDA does after the drought monitor is prepared and sent out, USDA does an overlay. So they say, okay, how does this drought monitor map compare to or overlay with where different crops are grown and produced? So any zone, any region that is a D1 or greater is in this hatched area, this red hash area. Okay, the green is where do we produce soybeans? The darker the green, the more bushels of soybeans are produced. Now, this is a bushel count, it's not an acreage count. So this is all about production. This is how many bushels are being produced. Okay, so notice, where are the areas that we really need to be paying attention to? Based on the drought monitor map, where are the areas that we need to be paying the most attention? Where are the areas that are on the bubble when it comes to potential yield decreases or yield problems? Obviously, here in North Dakota, the drought here is not a secret. It's been known for a while. Same thing in South Dakota. Also notice that South Dakota produces a lot of soybeans. The dry area in South Dakota, the drought is basically covers the whole state. Southern Minnesota and Iowa is really where a lot of folks are emphasizing or watching the closest. North Dakota is important, South Dakota is important, but the dry weather we've had here is a known commodity. The issue that's been happening now over the last several months is the dry regions in southern Minnesota and Iowa have been expanding. They've been getting deeper. And obviously, when we look at total bushels produced, those regions are significant. And that's where we have this dichotomy. That's where you got this difference of opinion about what yield and yield potential may be. Because you look at the Western Corn Belt. Now, usually the Mississippi River is the division between the Eastern Corn Belt and the Western Corn Belt. So you look at the Western Corn Belt, which is Minnesota, Iowa, North Dakota, South Dakota, Nebraska, and then parts of Kansas. That's on the dry side, definitely the northwest part. The Eastern Corn Belt, and actually as you get into that Mississippi River Valley, they've had either very, very nice rains or in some cases excessive rains. So this is really the tale of two different crops. We have the Western Corn Belt, which is very dry. We've got the Eastern Corn Belt, which is either just about ideal growing conditions or a little bit on the wet side. Okay. So one of the other pieces of information that gets updated, again, whether you agree or disagree with the numbers, is irrelevant. What it means is this does impact market psychology, is the crop progress. Now, in my opinion, these numbers there's a lot of pressure put on these numbers, right? Now, in my opinion, there's some folks that are putting excessive pressure on it. They're actually trying to forecast yield and yield potential based on this information. My personal view is I understand why people do that, and I'm not criticizing them for trying to do it. I am concerned that they're pushing too hard, that they're taking some very subjective ratings and they're trying to use those to come up with a hard number. And that's always a little bit dangerous in my point. So anytime you do this analysis as a researcher, as I was going through my training, you know, the reliability of the information coming in directly impacts the reliability of the product coming out. So please be a little cautious when you listen to people that are using these crop condition or crop progress reports to try and forecast yield, because it's always a little fuzzy and I get a bit uncomfortable. But what we are watching, of course, is not only the change from, this is the 18 states. So this is the major soybean producing regions. We usually add the percent good and excellent together. So in this case, we've got 59% of the crop is rated good to excellent. So we compare that from this week's number to last week's number, and then the same number this time last year. So you can see that there really wasn't any change from this week's conditions to from last week. We didn't really have any improvement or decreasing conditions, but we are behind the condition report we saw this time last year, which again is not surprising given the fact that southern Minnesota and Iowa are having some issues. Okay. Now, normally that's where it stops, but we can take a look at individual states. And this is one of the reasons I wanted to talk about this. If we start looking at the crop ratings in Illinois versus the crop conditions in Iowa, we see that they're very similar. Okay, so we've got, what is that? Add that up, 56% good to excellent in Illinois. We got about 65% in Iowa. So why is this conundrum? Why is there this difference? If the drought monitor map is showing that Iowa is, and in particular, a big chunk of Iowa is in this D1 and D2 stages, you know, why do we have the crop condition ratings as strong as we do? Part of it is, again, as you know, it's the timing of rainfall and the amount of rainfall, and what do we see in that root zone? What's happening in the soil profile? Now, Minnesota is in a little tougher shape. You can see that the crop condition reports and the ratings in Minnesota are a little bit lower. The North Dakota ones, you know, obviously in green, those are the ones that, you know, we're living with and dealing with. And I always get a little concerned about, you know, kind of backyard syndrome, where just because it's really dry and crappy in my backyard doesn't mean that everybody else across the U.S. is having a bad year. From a South Dakota, again, a little bit better than North Dakota, but only marginally so. Again, crop ratings in both North Dakota, South Dakota are really a concern. Okay, so now let's look at vegetative health. Now, this is part of the, if you notice on the bottom, the source for this is the Office of the Chief Economist. So this is the lockup briefing. This is really the information that was presented to the Chief Economist out of USDA before the WASDE and the production reports were released. So this, I took, basically captured this from that report. It gives you a pretty good idea using vegetative health, so that index of how green is the crop. And again, they're using this relative to this normal conditions. Okay, relative to normal conditions, what's the vegetative health? What do you see here? Yes, the crop conditions in North Dakota are in tough shape. The crop conditions in at least the major corn and soybean producing regions of South Dakota are in tough shape. Minnesota is starting to show up a little bit more of those red areas. We're moving from a nice deep green into the lighter greens and into the red areas, which means that the crop health is starting to deteriorate. Wisconsin is having some problems. Now, a lot of the corn and soybeans in Wisconsin, that's not as big a producer, obviously, as in Iowa and Illinois, but it is an area that we need to be watching. The market is zooming in on this southern Minnesota and northern Iowa region. Now, notice southern Iowa, kind of you can divide the Iowa east to west, the top half, the north half and the south half, you got kind of two different crops. The north half is looking at like we're having some stress issues. The crop crop health is deteriorating, but the bottom half is still looking like they're having a pretty good year. Also now shift into the Eastern Corn Belt. What's going on in Missouri? What's going on in Illinois, Indiana, Ohio, Kentucky? And then as we get up and down the Mississippi River Valley, all of this region produces a lot of soybeans. So we need to be watching the weather, the crop condition index. There is also a source, I've talked about this a couple times before, on soil moisture conditions. Now, this is all based on satellite imagery and overlays of rainfall. They've been testing this. NASA actually put together the satellite imagery part of it. The USDA has been working on how do we correlate this information into kind of estimates of what soil moisture are. So I don't want to put a lot of pressure on this because it's, you know, it's kind of new technology, but it does help us kind of understand and get a better picture for where are the areas that are right now have the toughest conditions. So this is estimates of the percent soil moisture. Okay, so this is volumetric soil moisture. This would be in the top 5 centimeters. So this is about the top 2 inches of the soil. Okay, now again, this is, I'm not going to put a lot of pressure on it, but it does help tell the story. When we, as an estimate, what do we see happening here in Iowa and southern Minnesota when it comes to that top root zone? Now, again, just this is the top couple inches of soil. They've been getting some rain showers through. There's enough moisture there to kind of carry the crop forward, make sure that the plant is still in reasonably good condition. But as you get into central Minnesota and then obviously into North Dakota and central and western South Dakota, things change very quickly. Now, this is the exact same map, but now we're going to go 1 meter. So that's about 3 feet deep into the soil profile. Even at that level, we do start to see in the deeper soil profile, there is some moisture. So if we can get, in particular for corn, if you can get some of that root zone, if those roots can go deep enough, fast enough to be able to tap into that lower soil profile, that may be able to help sustain yield and yield potential as we move through this as we get into the pollinating and the flowering stages for both corn and soybeans. I know Mark is going to talk some about this. I don't want to steal his thunder, but as we look forward in the next 5 days, this is the National Weather Service, the forecast for rain and rain potential. Actually, this is the amount of precipitation. So we see these areas that have been getting the rainfall over the last several months. Those regions look like they're going to continue to get some additional precipitation. Those areas that are dry and that are getting drier are also the ones that are also starting to miss the rains. So again, this will have some psychological impact on markets as we move forward. I do want to, okay, so I'm going to stop right there, Jenna. I'm going to stop right there. Are there any questions before I shift into corn? I do want to make a few quick comments about corn, and then I will also kind of wrap up this section talking about some strategies for how do we deal with this market volatility and how do we deal with some of the uncertainty about yield and yield potential.
So any questions? I don't see any in the Q&A tool right now, Frayne. But if anyone has any.
Which is fine. That's fine. So if there are some questions that come in, I'll be taking a couple other short breaks here just to do a check-in.
Nope, that sounds great. Yep, none right now.
All right, very good. So let's dive into corn. Very similar. Obviously, this is supply-demand table for corn. We did get a slight adjustment upward in planted acreage for corn based on our June 30 acreage report that's already in the marketplace. The yield numbers, just like the yield estimates for soybeans, are trend line yield. I'll show you a trend line in just a moment. Exactly same questions. We're really focused on this production and production issue. What is our yield potential going forward? And this is going to be the hot topic until the combines start to run and we actually get some field reports on what the crop is looking like, both for quantity as well as for quality. Now, the trend line for corn, the little dotted line on the far right-hand side, is the current USDA forecast. Again, up until the August report. So from when the first numbers come out in May through July, USDA uses this trend line yield. And again, it's adjusted up or down a little bit based on planting conditions and planting progress. So we're really pretty much right on trend line. So this is an average yield. The assumption going into this last supply demand estimates is that we're going to have an average yield, again, adjusted for technology and farming practices. Now, oops, let me go back. As I said before, August is the first month that USDA changes their procedure. Just like on soybeans for corn, they're going to do a farmer survey and say based on what you see today and normal weather going forward, what do you expect your yield and yield potential to be? They're also going to use some of the satellite imagery, what I showed you just in that vegetative health index. They're using some of this information to try and make some yield forecasts based on what they see on the ground. Again, we can question the accuracy of that, but these are the numbers that the traders are going to use, and they set their expectations, okay? Now for corn, old crop corn, if we look at the stocks to use ratio, again, we're taking ending stocks divided by total use. Our old crop ending stocks are very similar to what we saw back here in this 2012, 2013, 2011, and 2010 range. Again, that was the last time we had some really, really high commodity prices, right? And we're seeing some more average prices for corn to go up. We're seeing a lot more corn volatility. The difference in the corn side is because of the increase in acreage. And right now, the assumption that we have a trend line or an average corn crop across the whole US, we are expected or forecasted to slowly rebuild some of those ending stocks. So our ending stocks are still a little bit uncomfortable, but they're not as desperate, or they're not as tight and excessively small like we saw for soybeans. So the soybean S&Ds are exceptionally tight. If we get an average corn crop, corn prices will likely stabilize at these levels and may actually come down depending upon, again, the quality of the corn crop, the test weights, etc. So based on the numbers right now, we're going to have a little bit larger ending stocks, a little bit more flexibility in our supply chain on the corn side than we do on the soybean side. One of the reasons that our ending stocks are again strengthening or getting larger is not only again because of the production, but we're also seeing the forecast for a slight downtick in corn exports. Now, again, I don't want to press these numbers too hard because these are pretty some long-term forecasts, and there's a lot of stuff that can change. But I'm just trying to give you an idea of what are some of the things that are embedded in all of these assumptions that USDA is making as they're putting these numbers together. So it's looking as though the total amount of corn going into the feed sector will stay relatively stable. We may see a slight increase in the amount of ethanol, amount of corn used for ethanol, which makes some sense as we reopen our economy, we start to drive some more miles, we're going to use some more gasoline. They're all are calling for a slight reduction in the very strong corn exports we saw last year. So the translation to that is I do think USDA is expecting China to come in and continue to be a pretty strong buyer of US corn. The real question is, how big an appetite do they really have? Was some of the purchases last old crop marketing season an attempt to try and rebuild some of their government-owned inventories, or was this all just short-term current demand? Still a lot of debates and discussions about that. One more time, just to remind the drought monitor map, this is also impacting psychology in the corn market. Now, this is the corn area. So when we look at bushels, what percent of the bushels we produce are covered by drought, about 38% of the bushels is covered by some type of drought right now. And that's pretty significant. So there's still a lot of yield uncertainty on the corn side. That's one of the reasons that we are going to see volatility in the corn market, but maybe not quite percentage-wise the volatility we saw in soybeans, just because we do have a little bit bigger buffer or a little bit bigger kind of reserve or shock absorber in the form of carryover stocks. Okay, but those core regions that we're concerned about for soybean production, we're also concerned about for corn production. So the bullseye that everybody's watching is southern Minnesota and Iowa. Okay, so we look at crop condition ratings. We look at what was presented this last week, which is right here, versus the previous week. Very small changes. We compare the crop condition ratings this week versus this time last year. And again, surprisingly, they're not that dramatically different. However, the location is slightly different. So when we look at crop condition ratings, again, when we look at Illinois and Iowa, you add those together, they're going to be very similar. One of the reasons, even though there's some drought conditions showing up, some of those Iowa producers have also been getting enough rain to be able to keep the crop in condition. But they are right on the bubble. I mean, this is kind of the issue. If we get into a hot, dry spell, especially as we get into August and the pollination, late July and August, when we get into flowering and pollination, flowering for soybeans, pollination for corn, we're going to see exceptional volatility. There's going to be a lot of uncertainty because we know that those parts of Minnesota, again, Minnesota crop conditions are much smaller than they were this time last year, as well as for parts of Iowa, there's some concerns. We also know this is known commodity. This is not a surprise to anybody. Both North Dakota and South Dakota are having problems. Okay, again, this has been going on a little bit longer and the drought is deeper in our region. Vegetative index, again, this is both corn and soybeans. So I focused on the soybean issue before, but also looking at it from the corn perspective. We know that North Dakota and South Dakota are having troubles. The conditions in Minnesota and Iowa are deteriorating. The question is, how quickly will it deteriorate? So let's talk about price volatility. And I want to put this again kind of back into historical context. Now, this is a chart that I pulled last night. So this is kind of from late last night. I tried to get as current as I could. This is a long-term, what they call continuation or continuous chart. It's for nearby soybeans, excuse me. This is nearby soybeans. So it's only kind of current delivery. And the reason I use that is just, it's simple to pull up. I just want to look at what is going on today in the soybean market versus what has happened in the past. And I know there's a lot of folks that are focusing on that 2011, 2012, 2013, and even into early 2014, kind of this range right here where we've had these record high soybean prices and record high corn prices. I'll have the same chart for corn in just a minute. We also had some issues showed up. There was some early season concerns and drought conditions back here in 2008, where we had this price spike. I want to say this is what's happening today with our current conditions of soybeans. This is what's happened historically. And I kind of, as a reference point, I tried to draw in some of the black lines, which is kind of a relatively wide trading range, and then these narrower ones with red, kind of a little bit tighter. So what was kind of that normal trading range, normal in air quotes, trading range for soybean prices, nearby soybean futures during these time periods? And if we look at where we are today, and this is again as of last night, versus the average that we were during this 3 or almost 3.5 year time period, you know what, guys, we're kind of right in the middle of that. And notice what we have for volatility ranges. We're touching this upper bar, which I drew back here. The spike back here is where I drew the black line there. And the red line is kind of where we saw some of these lows hit during this time period. So we're bouncing within this trading range that we have seen previously. Now, I understand this is a tremendously wide trading range. I mean, we have well over a $3 range here in the last couple months. So marketing and trying to put a marketing plan together for soybeans has been a headache. And I truly sympathize with what's going on, because you see these prices, you'd love to be able to try and forward sell something, but guess what? There just isn't, we just don't know what the yields are going to be. The yield uncertainty is really driving us nuts. So how much do you dare forward price given what we're going on today? So I've got an example I want to go through just to stimulate some thinking on your part to say, well, there might be a way to be able to help manage some of that price risk. So I went back, and again, I want to go back to this chart. So I went back and I looked at, for each of these marketing years, for 2008, 2011, 12, 13, and actually I think into a bit of 14. So what were the highs? What were the price highs that we saw for not spot market, but for the new crop? So I looked at the November contract for 2008. When was the high set for the November 2008 soybean contract? The high occurred on July 3rd at 1637. How about 2011? That was one of the other big high price years. The high of the year, the high of the November, excuse me, not the high of the year, the high for the November contract, for harvest delivery contract, occurred on August 31st at 1465. Now, 2012, that's the one everybody points to. That's the one everybody remembers, right? That high was hit for November delivery, for harvest delivery. That was hit September 4th at 1789. In 2013, the high for November delivery was in June 12th at 1560. On 2014, the high was actually in May. By the time we got the crop planted, everything collapsed. By the time we switched kind of into this mentality, oh, we're going to have a crop. So the high was hit a little bit earlier in 2014. But when was the high? When was the contract high for November delivery for all of these previous big years, these big price years that everybody trying to remembers, right? It's July, August, and September. Right now, as we head into this mid-July and August and early September, we are now in the gut of this price volatility. Now, a lot of people are questioning, have we already seen the market highs? For soybeans, I'm not convinced. But what happens after harvest? Why are these the highs? Well, because this is the time that we have the greatest yield uncertainty. And when the yield uncertainty is there, we tend to have a risk premium that's put into the market. By the time the combines start to run, guess what happens? We have more certainty about what yields are going to be, and some of that risk premium's pulled back out of the market. So here's your conundrum. Here's your puzzle. If the highs of the year, if the high prices of the year are going to occur just before harvest, and I'm really worried about how many bushels I'm going to be able to actually deliver, how do I try and price that? Do I take do I lock in a price and then take the yield risk, or do I wait and see how many bushels I have and then risk the chance that prices are going to go down? And guys, I get it. There's no quick, simple answer to this. Okay. Let's do the same thing for corn. I've got one suggestion. I got one thing I want you to think about as a possible way to deal with this. Okay, so hold on just a minute. Let's look at the same thing for corn. This is continuous nearby corn. So this would be spot delivery corn. We see some very similar patterns. Like we got a spike in 2008. Again, there was some weather issues that we had. We've got this time period in 11, 12, and 13. By the time we got to 14, things had dropped pretty significantly. So here's where we are today. This is in the corn area, right? Okay, yes, we're seeing corn volatility. We haven't quite seen these big highs that we saw in 08, 11, and 12, but our carryover stocks are a little bit more comfortable. And right now, the forecast is for a slight rebuilding of inventories, even though some people may not believe that. So yes, we've had some pricing opportunities in corn, but we haven't quite reached these highs that we saw back here because, again, our reserves are a little bit higher, if you remember from my previous charts. Okay, but we are in at least the lower half of this trading range that we saw back here. So there are some pricing opportunities, but I understand you also have this same problem with, well, when do the new crop highs hit? And what does that mean for my yield and my ability to be able to commit to be able to sell some product? So once again, I went back in time during 2008, 11, 12, 13, and 14. When were those contract highs? Now, this would be for December corn. Okay. Well, it's in June of 08 at about $8, June of 2011 at about $8, August of 12 at about $8.50, and then again 2013 was hit kind of early on in January, and then by the time we got to May of 2014, things had dropped quite a bit. So in these big spike years, when did that happen? Two of them were June, one is in August. And the 2012 was also a very dry year. That was the other drought year that we had. Okay, so these were really weather concerns that turned better as we went through the growing season. This was one of those years where we had early, it looked like we're going to have a pretty good crop, but as we went through the rest of the marketing year, that crop quality or the crop quantity started to deteriorate. Okay, so once again, the high of the year, the high for new crop deliveries was set before combines ran. It was set during this key reproductive stages. So here's my opinion. This is a suggestion. I'm not ever going to tell you what to do because every farm is so different. How do you deal with this? Well, I don't know how many bushels I'm going to have, but I should really try and do some additional pricing. The first thing is, of course, what's your risk tolerance? And so again, I'm not going to push this really hard. I'm just throwing out one possible solution to this. Well, because we're concerned about the bushels we're going to produce and cash deliveries, try and avoid those cash market-based contracts, the basis fixed contracts, the futures fixed contracts, the straight up cash deliveries. Because if you have a production shortfall, now you have to work with the buyer and try and figure out how do we deal with this shortfall. And that's one of the concerns, a legitimate issue that farmers have. What I'm suggesting is looking at, rather than going with a cash-based contract, try and price your crop using futures or options. Okay, now you can focus on either selling futures contracts at a targeted price. And what happens then is if we do have a production shortfall, if it looks like our crop is going to be much smaller than we thought, we can reverse or offset that position very, very quickly. As soon as we know we're going to have a problem, we're not going to have enough bushels to cover our hedge, you can roll back out of those. You don't, number one, you're not forced to have physical delivery, but the second is you can add or subtract, you can get into or get out of these futures positions or options positions very, very quickly. Okay, so let me go through a very quick example just to demonstrate what I'm talking about. So please, I put these numbers together just for simplicity, so the mental math would be simple. Okay, let's say that you got a soybean APH of 40 bushels per acre. Okay, you plant 1,000 acres. So you're looking at 40,000 bushels of total production. You've already cash forward contracted about 10 bushels per acre, or about 10,000 bushels. So you're going to break up your marketing here. This is very common. So you've already got a cash forward contract for delivery at harvest for about 10 bushels of your expected production. Well, you know what? Your current yield estimate, given what you see today in your fields, you're saying, you know, if things go well, I could probably get 30 bushel. Is there a way that I can price some of those bushels without taking too much risk? Okay, well, one possibility is to price an additional 10 bushels per acre, not all of them, but an additional 10 bushels per acre using futures contracts. So 10 bushels per acre, 1,000 acres, you're looking at pricing an additional 10,000 bushels. That's 2 November futures contracts. Okay, so you watch the markets, you try and work with a broker, you lock in, you put an order in ahead of time. So you're picking a pricing point saying, look, if the futures market gets to X, I want to sell an additional 2 November soybean contracts at that price. If it hits, if the order hits, great. If it doesn't, it doesn't. Now, if as you're going through the rest of the season, if this continues to be hot and dry and you're saying, oh man, you know, I don't know if I'm going to make it. If you actually harvest 25 bushels, okay, you've got 20 of those already pre-priced. You've got 10 of them you sold as a cash delivery contract. You have another 10 bushels per acre that you sold as a futures contract, as a hedge. So you got 5 bushels that haven't been priced yet. You can do that after harvest. Now, the only condition with that is obviously when you actually do sell your cash grain, and the assumption is you're selling it off the combine, that you offset your futures position. Make sure that you lift the hedge. Now, unfortunately, if worst case scenario, all of a sudden weather remains hot and dry, and it doesn't look like you're going to get the 20 bushels because you've cash forward contracted 10, you've sold in the futures from a hedge another 10. You're saying, well, what happens if I get 15 bushels? Look, or 18 bushels. You can still resell or offset that one of those contracts, 5,000, at any time. So it gets into September and it looks like, you know, we're just not going to make it. Now, all of a sudden, I don't have that hedge position. I did lock in a relatively good price, but there's some bushels that I don't have. So I'm going to offset that at any time. Now, recognizing you still have 5,000 bushels that have been hedged, or about 5 bushels per acre that remain hedged. So you resold one and you still own one. Or excuse me, you've sold one and you've repurchased one. the thing is, the point I'm trying to make is there's no delivery requirement. So you can get into and out of the hedge as quickly as you want to. Okay, yes, there could be a gain or a loss on your repurchase. So if you sold it and you buy it back, sell it high and repurchase it lower, okay, you've got a gain. Now, if you sold it and prices go higher, obviously you're going to have a loss on that portion of it, at least on those 5,000 bushels. You do also then have to work with a registered broker. This is not something you can do all by yourself. Your local elevator is not going to do this for you because this is a hedge position. They want to have some kind of a cash contract backing it so that they can have the physical delivery. Okay, so you do have to work with a broker. You will be exposed to margin calls. You're going to have to set up the margin account, make sure that all of that is working properly. So this is not something you can do just, really super quick. It is going to take a little bit of planning, but it is a way to be able to do some additional pricing, even though you don't know what your yields are going to be, without tying your hands too much on the cash market side. Okay, that's a lot to absorb. Are there questions? We're going to take a pause here. Are there questions before I move into some of the technical analysis and getting an idea where some pricing points are?
I'm not seeing any immediately, but I'm watching both the Q&A tool and the chat. So if anyone has any questions for Frayne about those fundamentals, some of the marketing plans that he went over, I will pass those on.
Okay, like I said, I'm just going to give people a few minutes here to take a breath and let me catch up on my stuff too.
That sounds good. While Frayne's getting set up, I'll keep watching those, the Q&A in the chat for questions. But Frayne, if you don't hear from me, I would say you can just, once you're ready, go into your technicals presentation.
All right, so let me do my screen share here. Okay, so on the technical side, what I thought I'd do, rather than going through PowerPoint, I thought I'd just show you live kind of what's going on today, and we'll start looking at what some of the pricing points are. So I'm gonna focus on this November 2021. I'm gonna look at the November contract for futures. I'm just gonna pull up this chart, and we're gonna start playing around with some of the numbers and start looking at what's going on. So you'll notice in the black, that is the current market price. So this is real-time markets. This is what's actually happening right now, this moment. So you'll see that number kind of bouncing around and moving up and down as we move through this. So this is a bar chart. So this is a chart of historical futures market prices for the November delivery contract. Each one of these black bars represents one trading day. So we're going to use this information to try and say, well, if we are going to place a hedge, if we're going to try and do some hedging, what are some pricing points? Do we see some trends in the marketplace that might give us some idea of not only pricing points for a hedge or just general market movements? Okay, I'm going to start really simple. We're going to move into some of the more of the stochastics, just to get a kind of a feel for what are some of the signals and kind of indicators that the other traders and analysts in the marketplace are looking at. So again, this is a tool not only that you can use, but also helps us understand what are some of the other things that other traders and analysts are looking at. And in particular, I'll show you some information on the kind of the positions for the managed hedge funds, and we do want to talk about what's happening from the fund side and what's happening with this money flow, because that obviously has huge impacts on prices and price volatility. So one of the first things we do in at least when I teach this to farmers on charting and charting techniques, we just use simple trend support and resistance lines. So the blue lines that I placed here, I've drawn in trying to hit either a high or a low. So what we're looking at is if we've seen a price increase, at what prices will prices kind of top out and turn around and come back down again. So those become some of these psychological barriers. And if you'll notice as you go down here, there's very often, I've said this many times, it's very often that these numbers come very close to a nice even number, like 1480. Okay, and it's in a 5 or a 0, where there are these psychological barriers. As prices go higher, there's these psychological barriers where all of a sudden either buyers or sellers say, you know, that's enough. You know, we either it's an opportunity or that's high enough, right? So as we get into this 1480 range, what does that mean? It means that as we move into higher prices, there gets to be more sellers, but fewer buyers. And at some point, the amount being sold is greater than the amount being bought, and prices go down. So at what point would you start placing an order, right? Either as a buyer or a seller. So what and there's some debate and a little bit of art as well as science that goes into this, but I've chosen some points that I think are key psychological barriers. We have this high back here that we set in June at 1480. We've got a more recent high where we had a spike up and with a relatively quick drop down at about 1420. I would call it 1420. We've got some lows that we set down here at about 1240. We've got one back here at about 1325. So this kind of defines, at least short term, this kind of defines our trading range. Okay, from about 1240 to about 1480. Now, I realize, again, that's a very wide range, but these are some pricing points where we've seen these significant shifts or turns. Okay, so I'm going to take off a few of these just to make things a little easier to see. So I'm going to delete a couple of these. We're going to keep several of them, but we're going to delete some of them. One of the other tricks or techniques that's used against drawing simple straight lines is a trend line. So I'm going to add a trend line. I need to get there we go. We're going to do a trend line right here. We're going to start down here and we're going to draw a line something like so. So what happens is we have a general movement upwards, even though we've had quite a bit of volatility. We have some general price movement up. Now, this trend line will stay in place. This one will stay in place as long as when prices fall down, when they start to retrace, they stop at approximately that trend line and then rebuild from there. So we're getting this bouncing action. And every time that bounce happens, we bounce at a slightly higher level. So we do have an upward trend. It looks as though the next, again, major price resistance level that we're going to get is about that 1420. So if I come back to the strategy I just talked about as far as hedging, one of those first places you may want to do some pricing is at that 1420 level. If you think, or if you're really risk averse, or if you think that there's going to be bigger and bigger problems as we move into the summer months, as soybeans get into this flowering and pod set, you might want to put one at a 1480. Okay, so let's look at a couple other techniques that we can use to try and look at price movements and psychology in the marketplace. So I'm going to take all of these off. Hang on. There we go. I'm going to add a study and I want to do Bollinger Bands. So Bollinger Bands is something that we usually talk about, and I'm going to have to, unfortunately, there was a software update recently, so I'm going to have to change a few of these colors here just to make them stand out a little better so you can see them. Okay, we got that one. Average, we're going to use red. And then low, we're going to use blue again. Okay, so this is Bollinger Bands. What we're looking at is a 20, we're looking backwards in time 20 days. We're looking at, given the last 20 days, how did today's prices compare to those last 20? So the red bar and the red line in the middle is the average. So it's a moving average. We're taking the last 20 days, the close of the last 20 days, and we average those out and saying, well, given that as a historical perspective, are we above or below average? Well, in today's market right now, we're at it. We're above the average. These blue lines on the top and the bottom are that range. It's that standard deviation. So it's a measure of variability. Okay, so are we at the upper end of the historical range of prices or the lower range of historical prices? So these are kind of considered those typical boundaries. Are we at the upper end or the lower end of the range? So we know that we're kind of above average, but given where we are right now today relative to this kind of historically based upper end of the range, it looks like about 1440, given the information we have right now, at 1440 would be that upper boundary. So as we get closer and closer to these levels, and this is dynamic, so every year, every day, this is going to change a little bit. We're starting to say, you know, we'll probably get some pretty significant resistance levels as the prices get either at the very top of these, the blue bar, or some support levels as we get towards the bottom. So we've got in one sense, we've got a general upward movement in prices. The average looks like it's starting to flatten out, and our range is starting to narrow. So we had significant volatility back here, you know, as we moved into this USDA crop report. But now that we have this new information, things are starting to stabilize a little bit. Okay, so Bollinger Bands is saying, well, we're in the upper end of the range, but we haven't really reached the top levels, kind of those major psychological resistance levels. Okay, so let me delete this. Yes, I'm going to go to another study. We're going to go to RSI, this relative strength index. Okay, so this is another tool. If you've gone through some of the marketing programs that we sponsored here at NDSU in the trading room, these are some of the things we talk about. So RSI, relative strength index, we're just looking at that ratio of up days versus down days. Okay, we're looking at not only was it an up day and how rapidly did it increase, but also looking at down days and how rapidly did it decrease. The moral of the story, this is like a ratio, it's a percentage. So if we're looking at a ratio of 50, what that is telling us is that we've had about the same amount of up days as we have down days. Now, if you'll notice during the time periods when we have a lot of volatility, a lot of variability, both up or down, it's very unusual for this ratio to reach 70 or get above that to this 80, this critical 80 level, or on the downward side, where we're looking at a number that's near 30 or at the kind of that critical level of 20. So, moral of the story, what this is telling us, if we start to get this, it looks as though this kind of moving average, if you will, is right around 50, but it is looking like it is slowly starting to increase. This is one of those indicators that moves relatively slowly. It doesn't change very quickly just because of the way the math works. But we're kind of in this neutral position, but it looks like we may be headed upward slightly. We're not in this critical zone where we've had tremendous amount of upward movement, and it looks like that upward movement may be running out of energy. So this is kind of what I would consider or interpret to be more of a holding pattern, kind of a stabilization pattern. Okay. So let me, hang on, let me delete this and we'll move on to the next one, which is going to be our MACD. Okay. And I do want to change the colors here a little bit just so that it looks a little brighter so you can see a little better. Okay, so that's that one. And then this one we'll make a little thicker, we'll apply. Okay. So I really want to focus in on the red bars. So the red bars, we've got two kind of moving averages. We've got two different indicators here. We have the blue one and the red line. So both of these are moving averages, but we've done the math a little bit differently. So we've weighted the most recent information more heavily. So we are looking back in time, we're looking at a moving average, but we're putting a heavier weight on the information today relative to what happened in the past. And so the general idea is that if you have a short-term, a short-term moving average and a long-term moving average, we're going to look at that relationship. And so these red bars represent the distance between the red line and the blue line. So the math behind it is we're focused on the red line and the blue line, but we're really looking at what is that difference? What is that? What's the rate of change? So the way we interpret this, if you notice, there's kind of a correlation, a relationship between what's happening with the red bars down here and what's happening with futures prices up here. So again, this is kind of looking backwards, but it gives us an idea of what the future may bring. So notice we start to see this cycling going on. What the height of these red bars indicate is not only are prices moving upwards or downwards, but what's the rate of change? How rapidly are we increasing, or how rapidly are we decreasing? Now notice right here, we had a time period where we had prices starting to go lower. The rate of change, the rate that it was dropping, started to increase. And then we continued to have prices fall, but they weren't decreasing as quickly. And we went from a falling market to an increasing market. So based on this interpretation, what this is telling us, let's see if I can zoom in this a little bit. What this is telling us is that we are in starting to get into an uptrend, that when an uptrend has started to develop, that uptrend is starting to gain some momentum. Okay, now it doesn't really tell us where that's going to tip over until we have a little bit more information. So all of these places where we go from a negative to a positive and a positive to a negative, whenever it crosses that zero line, is kind of these tipping points, or what we call the inflection point. So those would be the pricing points where we start to see, oh, prices might be reaching a peak or a trough, depending upon the momentum that's going on in the marketplace. Okay, so what does all this mean? What are we seeing? We have a relatively slow moving indicator, meaning the RSI, that's giving us an indication that we're kind of in this stabilization mode, but we might be turning higher. We have the MACD, this one, that's looking and saying, well, it looks as though we have an upward trend that's starting to develop. We've got some momentum building to the upside. We use the straight line for just a simple trend line that yes, we are in an uptrend market. And then what was the other one? Oh, and then we had the Bollinger Bands. So we had the Bollinger Bands. We're saying, yes, we're in the upper range, but we may not have quite reached that kind of that resistance level that we see in this historical price ranges. Okay, so we've got essentially three key factors, three key indicators saying, yes, we have an uptrend. It looks as though that uptrend has some support, but it may not be moving up rapidly. So again, this will obviously depend upon the weather and weather forecasts and the fundamentals. There is one more indicator I forgot to include, and I apologize. I will add that right now. And that's this moving average crosses. Okay, so this is another, I'm going to change the colors here again just to make it brighter so everybody can see what's going on. I do want to change this to a 20-day, a 40-day, and a 90-day moving average. So these, and then we'll look at lines. We'll just make all of these the same color, but we're just going to make them a little thicker, a little brighter so that everybody can see what's going on. So another way to think about support and resistance levels is to look back historically and look at these moving averages. Okay, and each one of these moving averages then becomes a different either support or resistance level. So we're looking back, and the reason we use 20 days, 40 days, and 90 days is 20 days is basically the number of trading days in a typical month, right? We usually have 5 trading days in a week. You got 4 weeks in a month. 20 days become a 1 month rolling average. So we've got a 1 month rolling average, a 2 month rolling average, and a 3 month rolling average. So if we look at today's prices and we're saying, well, how does today's prices compare against these 1 month, 2 month, and 3 month averages? And we'll use those as reference points. So if you look at the numbers today, we have today's prices above both the 20-day as well as the 40-day as well as the 90-day moving average. So again, an indication that we have moved through some of these longer term resistance levels, because on the way up, these lines become resistance. On the way down, they become support. So these, again, psychologically become some of those key numbers. Again, another indicator. So now we have 4 indicators telling us that we are in an uptrend, that this uptrend has some movement to it, but we have to be a little cautious that upward movement may not be as strong and aggressive as we were hoping for. Okay, the market's kind of taking a breather here. We do have some concerns though, because our short term, our 20-day moving average, notice, has now started to flatten out and stabilize. It's been coming down, but it is now stabilized. The question is, will this start to turn back up again and confirm that we have a stronger uptrend? So where do we see some of these key pricing points? We see some key pricing points. Again, what the ones that I like to use are, I like the KISS rule, keep it simple, stupid. Let's look at those key pricing points where we have these previous spikes or previous lows. So I'm going to add those back in again so everybody, so everybody can see where I'm talking about. We need to do this, and we need to do horizontal. So we're going to add one here. Let me move that up a little bit because I didn't quite get it positioned correctly. Move it about there. We've got one back here. Oh, come here. Get my mouse working. Sorry about this. So those are some of the pricing points that we had, right? So again, when I come back to the fundamentals, we are going, in my opinion, going to be heading into some higher price volatility time periods, especially again, as we get into flowering and pod set. The volatility can be both on the upside and the downside, depending upon weather. So this doesn't automatically mean that we're going to have higher prices. It does look like we are starting to rebuild into an upward trend. I do think some of this first pricing point will be about 1420, 1425. This 1480 is kind of the previous high. We got to keep that in mind. There's going to have to be a lot of price momentum. There's going to have to be a lot of things starting to go wrong before we really start pushing through that 1480 number. But we do have some support down here at 1240 as well. We've got one here is this one is at about 1328. Okay, so I'm going to take another pause. We're going to take another break here and say, are there any questions? I know I blew through this pretty fast, but I do want to do a similar thing for December corn because there's some things happening in the corn charts that I think may spill over into the soybean market. So are there questions?
Any questions for Frayne about the soybeans that he covered here? We have a quiet group this morning, Frayne. Maybe it's because you're first. You might be lucky.
Yeah. Everybody's still trying to get their mind wrapped around what's going on here.
Yes. I'm not seeing
All right,
anything
and that's fair. So
okay.
Before I kick into corn, before I go into corn, there's one more thing I wanted to mention. I've got it on my notes here. I just want to make sure. We're going to look at the CFTC reports. So let's go to soybeans. Okay. I'm going to see if I can rescale this just a little bit to make it easier for everybody to see what's going on. Okay, so what is this showing us? What I've calculated here, and actually this is part of DTN, again, the Profit X. I gotta stretch this out a little bit and make sure that I've got, there we go. So let's look at the CFTC report. So the CFTC is the Commodity Futures Trading Commission. So every Friday, they provide public information on the trading positions of clusters or groups of traders. So we have what's called the commercials, which are typically those people that are both dealing in the futures market and the cash market simultaneously. So that would be you as farmers, that would be grain elevators, it'd be processors, it would be export companies, it would be international buyers. Okay, these are the people that are typically hedging, where they're both in the cash market and the futures market. They have also for what's called non-commercial, which is kind of the traditional, what I would call traditional speculators. And if you notice, they also have what they call the money. Okay, so these would be managed hedge funds as well as index funds. And in particular, these managed hedge funds are the ones that kind of come in and out of the marketplace very, very quickly. They're using the futures markets for grains as well as other commodities like crude oil and precious metals to try and manage a portfolio of investments. So depending on what's going on, they're coming into and out of these different markets very, very quickly. And these managed hedge funds are the people, the traders that kind of drive us nuts, okay? Because they're the ones that can shift their positions very, very quickly. Now, what I've done here is I've calculated what's called a net position. So let's just look at individually. We're going to look at how many long positions do these managed money, what we call the money area, the funds, what kind of long positions do they have? Long meaning that they have bought, buy low, sell high. So if we see an upward trend in prices, if we see a lot of building and excitement in the marketplace, they're going to come in and start buying and hold those positions until prices look as though they're starting to tip over or go down. So buy low, sell high. As the price trend continues up, you'll start to buy as a speculator until it turns over, and then you start to sell, and usually sell very heavily. So let's look at, this is just the number of contracts that are long. Now, the other thing I want to be very specific on this chart, this is all positions in the soybean market. So it's all trading months. It's both futures and options positions blended together. But it is a really quick snapshot of what happens. Okay, so let's look at these number of long positions that have occurred over the last several months. So if we've seen, the red line is the nearby futures. So the red line is the nearby futures price. The black bars behind it are this long position for these money traders. So notice as we started getting this nice rally that started basically at the tail end of 2020, look what happened to the number of long positions, the amount of contracts that have been bought and held by just this group of money traders, these traders that are in a speculative position, as that price has started to increase. Okay, now you'll notice we had a few bumps here. And every time we get a few bumps, we start to see this long position start to reverse. So every time we see a downward retracement, people have adjusted saying, oh, well, I'm going to take some of the money off the table. I've already bought, I buy low, sell high. I'm going to take my profits. I'm going to go home. Okay. Now, for some of them, they took they sold, they waited for the bottom. They're now starting to rebuild the position. So look what's happened. As we start to get prices higher and higher and higher, these long positions started to reverse. And one of the concerns we have now is that what will happen to these fund traders, these managed hedge funds, as we move forward into this really high volatile time period. And these traders can have a significant influence on the marketplace, but they tend to be market followers, not market makers. So they're looking at the historical patterns, and it's usually some kind of fundamental change, some kind of change in the psychology of the market because of the fundamentals that cause prices to turn. And once it's recognized prices are starting to turn, they've gone up for a long time, they're starting to fall, that's when all of these traders say, oh, well, it looks as though it's falling, I'm going to take my money before it falls even further. The exact same thing happens on the reverse side. As prices are falling, then all of a sudden it's like, when it looks like things are bottoming, it's like, well, okay, now we may repurchase those positions. So this is the long side. This is the number of shorts. Okay, and this is then the net position. So if we look at all the people that have bought, all the people that have sold in this bucket, in this category of traders, where do we sit right now? What's their net position? Okay, and it looks as though even though they still have a net long position, there are more buyers than have been sellers, this net position is smaller than it has been. Okay, so there's still an influence of these money market traders in the soybean market, but it's not as big an influence as it was, let's say, a couple months ago. And you do notice that there is this price relationship or correlation between what's happening in the futures market and what's happening as these traders change their positions. Okay, so enough of that. I'm going to go back. We're going to talk a little bit now. We're going to shift to corn. So we're going to do the same basic process, but I'm going to shift to December corn. Oop, it disappeared on me, so I've got to click this one here. Did I do that right? Yep, this is corn. So again, I'm going to remove some of this stuff just to make it a little cleaner. Delete that one. We're going to delete these. And we'll put them back in just a minute, just so it is cleaner. Okay, so this is December corn. So this would be new crop corn. We're going to do kind of the same basic process. So what are some of the key pricing points, the key indicators we've got? Again, I drew these lines in. You know, some other market analysts may draw them a little bit differently, but in my opinion, kind of these are the key ones that I'm looking at. We have a low back here at about 506, call it 505. We've got a high up here about a 611. So this is now kind of defining our short-term trading range. We do have some higher points back here, a lower point back. Well, actually, that's the low right there. We've got some others that we can get if we were to move lower. This 655, I put that in there because that, if we look back at a long-term chart, if we look back historically, even though the current high for the November contract is at 638, if I look back at time and say, well, when is the next big jump up? At what point do we see another resistance level? If we look back historically, this 655 kind of shows up as kind of that next point. So if we were to have some kind of major significant rally in the corn market, we were able to push through this about 610 mark. We were able to push through this 640 mark. Where's the next leg up? What's the next step up that we'd see in the corn market? That 655 seems to be that next major jump. So I just wanted to point that out as a reference. So where are we today? We're right in the middle of this trading range. Right? Now, one of the other things I want to talk about before I go too much further here is notice that there's this gap. And now typically when I go talk about charting and chart analysis, I don't spend a lot of time talking about gaps. And the reason is they don't occur as often as they used to. If you were to go back before electronic trading started, the gaps in these markets were actually had a very strong signaling strength. It provided some information to us. But when we moved to electronic trading and we moved to both nighttime trading as well as daytime trading, a lot of these gaps kind of started disappearing. We don't see them occurring nearly as often. So they're not quite as strong a signal. So when we do get them like this, because this is a significant gap, we gapped lower, that is kind of a major signal. So what caused this gap? Why did we suddenly think about, well, we're trading up here as a trading range and suddenly we gapped lower? Well, that was actually one of the USDA reports where all of a sudden we just gapped lower. It's like, whoa, that wasn't what we had expected. Now, from a technical analyst standpoint, this gap is usually what they call filled. So normally what we see is as prices, as they drop lower dramatically, they start drifting lower, they find a low, they start to rebuild. It's very common to have this rebuilding go through and kind of fill that gap area. So one of the other psychological barriers, even though it's not denoted here as a spike up or spike down, is actually at this is 575 level. And the reason that 575 becomes important is A, it's a nice round number, but B, that 575 also fills this gap. So it will be, in my opinion, very interesting going into next week, especially given some of the weather forecasts we've got going on. I suspect we will at least fill this gap, and depending upon the weather forecast, we may start to rebuild into this plus $6 range. Okay. So I'm going to take a few of these off again just to clean things up. So I did want to explain this gap. And as I said, there is this correlation. There's this relationship that goes on between corn and soybean prices and kind of what's going on with trader psychology. So I'm actually going to take these off of here, all of them off, and we'll start fresh. Okay. Oop. We'll go to a trend line, an upward trend line. Let me get to this one. Excuse me. And we do have a pretty aggressive trend line rebuilding in the corn market. So if we look at the last several days of trading, about the last week or so, we have a pretty aggressive trend line going up. When will that trend line turn? If again, when will we start to lose some momentum? If prices continue to go high, and as they retrace or fall back, they touch this line and continue to go higher, this trend line maintains its strength. So the key pricing points based off of the techniques we've talked so far, one would be this 575 to fill the gap. The next level will be at about, again, this about the 611 mark where we see the previous high. Okay, what about, I'm going to go back. I should have done this in the proper order here. I apologize. Let's go to this moving average crosses. And again, I'm going to have to brighten this up so everybody can see what's going on. I know this gets a little tricky. I wish this, I had a bunch of defaults saved, and when we updated the new version, all those defaults disappeared, and I haven't had a chance to replace them. So we're going to do 20-day, 40-day, and 90-day moving averages. And we're going to brighten these up so everybody can see what's going on. We'll make that thick. We'll make this thicker, and we'll make this thicker. Okay, so let's talk about what this is telling us. We've started now on this upward trend. Today's prices, we're starting to break through again. This is a 40-day moving average. The red line is a 40-day moving average. We're starting to break through. That's both a support and resistance level. It's a resistance level on the way up. It's a support level on the way down. We've gone through the 20-day moving average already. We're moving through the 40-day. So the short term is moving through a longer term. That's adding some support, some strength to this idea that we may be having an upward trend, and that uptrend is starting to add some momentum. If we look at the shape of this 20-day moving average, we have been going down. Looks like it's starting to flatten out. So is this an indication that, yes, the average is starting to flatten and we will go higher? We're going to have to wait and see a little bit. Okay, so we have a short term, which is today's prices, breaking through these resistance levels or support levels of the 20-day and the 40-day moving averages. Now, we did break through. The concern was when we broke through this 90-day moving average on the downside, that really was kind of a strong negative signal. But since then, we have rebuilt. This is better signaling. Okay, let me move now to the Bollinger Bands. This one right here. And once again, I'll have to change this so everybody can see what's going on. Just give me a moment. I'm going to turn that to red and turn this to blue so everybody can see. Oh, I missed that one. I am sorry. We'll go back and make that bold. We'll get it eventually here. Why did that change back to thin? There we go. Apply. Okay. Okay, so again, what is Bollinger Bands telling us? We've got the red line is the 20-day moving average. We've already moved through that 20-day moving average. It looks like the average is starting to flatten out, which is a good thing. So some of the uptrend we're seeing right now is offsetting some of the previous downtrends. What's happening to this range? What's happening to this range of potential prices based on history? We're starting to see that range narrow up, which is also indicating that our volatility, the variability of prices, is starting to narrow. Okay, so even though we're moving up on an upward trend, that upward trend is not changing as quickly as what we've seen in the past. So again, this is on the corn side. So we have an uptrend from a trend line standpoint. It looks like the Bollinger Bands is telling us, yes, we're moving above average for the last 20 days, but we're quite a ways from this upper range where we need to be concerned that we might be reaching some topping activity, where prices may be reaching a high and turning lower. Okay, we're going to move on to the next one. We're going to add a study. We're going to go to RSI, Relative Strength Index. So again, this is a longer moving average. We're looking at a longer time frame. This is a little bit slower moving average. We're also near that 50% mark. Notice back here, we saw this, the upward price movements being very, very strong and aggressive. When we see this RSI, when look at the percentage of the up days versus the down days, it's unusual to get up to 70 and even more unusual to hit 80. And we've done that several times in the corn market here based on some of the historical price movements. What are we seeing today? Again, we're using kind of the historical information. It looks as though we're kind of in this middle of the range. This is a little bit slower movement, but we are the average, the RSI is starting to turn higher. And that is an indication that we may be moving into a higher trend line or a higher price movement as we move forward. This, just one more time, how do you interpret this? As this ratio of up days versus down days start to change, when it gets close to 70, we're starting to say, ooh, it's very hard for a market to continue this rapid up movement for this long a time period unless there's something really special happening. Okay. So I'm going to delete this one and we'll move on to the next one, which would be, we got MACD. And again, I'm going to make these a little bolder so everybody can see it. Sometimes it isn't very easy to see some of these lines when they're on the computer screen. So I'm going to make that a little thicker. I want to make that a little thicker. Actually, I'm going to go back here. We're going to change the color too to make that. There we go. So for MACD, again, this is moving averages. So what we're looking at is the relationship between a short-term moving average and a long-term moving average. We're focusing on the red bars. Are we an uptrend or a downtrend? How rapidly is that trend changing? When we interpret this, it's been in a downtrend. It looks as though that downtrend might be reversing, or we're looking at an upward trend. So you notice that the blue line, which is a short-term moving average, is starting to catch up with a red line, which is a longer-term moving average, suggesting that if we look historically, it takes a while for some of these to kind of change momentum, but it looks as though momentum is building. We're going from a downtrend to an uptrend. The question is, how much momentum will that uptrend have as we move forward in time? So it looks as though in the corn market, we're on this kind of turning point, this tipping point from some downward momentum to some upward momentum. All right, are there any questions? I'm going to take a pause and then I will jump into the CFTC report for corn in just a moment. But I do want to stop at this point to see, are there any questions on some of this technical analysis stuff?
So I did see one come through, Frayne.
Okay.
I've got a question saying, which of your technical analysis tools would you consider to be retrospective and which predictive?
Okay, so formally, all of them are backward looking. Okay, all of these techniques are using historical information to try and give us an indication of what the future may bring. Okay, so from a pure predictive standpoint, there's no one indicator that is doing a superior job to predicting the future. So let me rephrase that. If I were somehow to create the ideal indicator using historical information, if I could come up with some kind of formula that I could use historical information to predict the future, I would not tell anybody. Because the minute that you leak that out and tell somebody, it's like, well, I think I figured this out, and you share it, and more people start to use that indicator, guess what happens? As more people use the indicator becomes less reliable. So one of the things I always try and preach, I always try and emphasize, is you can't just look at one indicator. This is like the gauges you have on the dashboard of your combine, or the dashboard of your tractor, or the dashboard of your car. Every gauge shows a little bit different indicator about the performance of the tractor, the combine, the car. Some of them are slow moving gauges. Some of them are really quick and jerky kind of responses to changes, but they all provide different set of information about what's going on. just like that, I like to use a set of indicators. So if we start seeing multiple indicators that are giving us the same general sense for price trends, price movements, then I feel pretty comfortable that that is legitimate, that there's enough going on here that I really need to pay attention. So what I'm trying to go through, the reason I'm going through so many of them is to say, here are the indicators that I tend to use personally to try and analyze and evaluate, but also there's a lot of other traders and analysts will be looking at the same thing. So I'm also leaning on the experience of the professionals to say, well, what are you watching to give an indication of what you think is coming next? And these are some of the very, very common ones that I see used by a set of traders. Every trader has their own kind of specialized ones they like. There's ones that they really feel comfortable with, but this is kind of a common set. So all I'm getting at right now, to recap on corn specifically as an application, is we have several indicators that are saying, yes, it looks as though an uptrend is starting to build. There's a couple indicators saying, well, we've had some recovery, but it really is it just a recovery to a more stable position, or is it really confirming that we have an uptrend? So we've got kind of two signals in the corn market saying it looks as though we're starting to change direction, but we can't confirm it. We have a couple indicators that saying, yes, there is an up, we have seen a bottom, or at least a short-term bottom, and we'll start to recover. So hopefully that answered your question. There is no perfect indicator. And all of the ones I showed you are using historical information as the basis for the forward-looking observations. I hate to use the term prediction because they're not really trying to predict prices. They're just trying to give us an indicator of market direction and market momentum.
Sure. So in using charts, in what market conditions would you suggest using charts daily versus intraday or weekly?
Okay, so the general guideline is it depends on what's your planning horizon. Okay, so if your planning horizon is I'm looking at trying to make a marketing decision in the next 2 weeks, I know that I have to make a decision in the next 2 weeks. The general recommendation is if you're looking 2 weeks into the future, you should look about 2 weeks backwards. If you're thinking about saying, well, I should really try and do some more pricing, some more marketing in the next month, you should probably look backwards about a month. So to answer the question directly, if you're doing some very short-term trading, if you're looking at, I don't want to call it day trading, but if you're looking at some really short-term stuff, if you're just saying, well, can I make some money trading today? If you're only looking a few hours into the future saying, well, what's going to happen next? You should only look a couple hours backwards, because what happened last week is irrelevant. Okay, so that's the general recommendation. The answer is it depends on what is your planning horizon moving forward. If you're looking at your planning horizon is the next month or the next 2 months, you should look backwards the next month or the next 2 months. You should try and match those up.
Sure. Those are the questions that I have seen come in.
Okay.
I'm not seeing any other ones come. We're a little bit over on time, but
Okay, I'm sorry.
No, that's okay. I was just gonna say, I do think that we probably need at least a couple minute break before we have Dr. Wilson come on next. So it is currently 9:43. Frayne, thank you for your presentation.
Okay.
Thank you for the discussion. Hopefully, maybe you can hang with us for a while. So if any other questions come up for you, I will work those in.
All right, very good. I'll be here.
Great. So let's resume. Well, it's currently 9:44. We will resume with Dr. Bill Wilson at, let's do 9:50. And then we will talk about the basis situation and the outlook for 2021 soybeans.
Jenna, can you hear me?
I can hear you, and I just responded to your email. We can see your NDSU slide in green right now.
Okay, so coach me through this then.
Is that your background, maybe? So
Probably.
when you hit share screen, it should have given you a bunch of options.
So I'm
And
going to stop sharing what I have.
yep, let's try it again.
Share screen.
Yep, share screen, and
How's
then
that?
yep, now I see your presentation. You're not in presentation mode though.
So go to slideshow.
Yep.
And from the beginning.
Yep.
How's that?
Perfect. And then if you want to advance one so we can make sure everything's moving. Yep. Okay. That's
So
perfect.
like I could be your assistant pretty soon.
Yeah.
Huh?
Well, it is 9:50 and I do want to keep us on track here. So next we are going to hear from Dr. Bill Wilson. Dr. Wilson is a distinguished university professor in the Department of Agribusiness and Applied Economics at NDSU. He's going to talk to us today about the basis situation and his outlook for 2021 soybeans. So with that, Dr. Wilson, you can take over.
Thank you, Jenna. Many of you probably heard me before. This is my favorite topic, but it's always tough following Frayne because he gives you so much insight. So I have this microscopic topic to cover called bases and spreads, and that's what I'm going to cover today. Let me just though put it in perspective. These are charts that I use all the time for analyzing markets. The top one's from Lisa Elliott of South Dakota. Bottom one's my own. And this shows a relationship of stock use ratio and futures prices. This year we're at a stock use ratio of about 3. And that would look historically suggesting a futures price of about 14. You can see in those years when we had the trade war, when we were having stock use ratio of around 15 or 20, we're at very depressed prices. But we've never really had prices, we've never really had a stock use ratio this high. That creates a high degree of uncertainty in the market. Nobody wants to sell because they don't know how much to sell. Nobody wants to buy because the prices are too high. So that means we get a lot of volatility. What this tells us is fundamentally you should be expecting an average futures price of about $14. A little bit higher. I didn't see it yet today, but probably a little bit higher than we are currently. So there's probably some upside. Can we deviate from that? For sure we can. Remember I said the average price would be about 14 bucks. So that's always the guidance in terms of, for me, as I think about the basis, what to do about the basis side of the market. In our trading room, we try to have as many sources of data as we can. These are all the data sources we have and use that are accessible both in our research program, Frayne's extension, as well as our teaching program. So I'm going to talk about the basis. Here's the basis chart on the spatial basis from late June for soybeans in North Dakota and the region. You can see in central North Dakota, we're right around 60 under. As I'll show you in a moment, we're a little bit stronger than normal. little bit stronger than normal for a number of reasons, which I'll discuss momentarily. So there's probably two concepts that I think are really important in understanding the bases and spreads. One is the price, I call it the price of storage. And I don't want to say I hate to teach this, but fundamentally is really important in making marketing decisions is an assessment about whether we're in a normal market or an inverted market. And this guides us about whether or not we should be storing a commodity or not storing a commodity. And we kind of historically didn't talk about this very much, but nowadays, for lots of reasons, it seems as though we are as frequently in an inverted market as we are in a normal market. So on the left-hand side, it shows if the price spreads in the futures market are positive, that provides a positive return to storage. So that kind of says you should probably store the commodity. Whereas on the right-hand side, you'll see the futures prices are inverted. We call that inverted, but it means deferred prices are a discount to the nearby. We call that an inverted market. And what that's doing is saying there's a disincentive to store. Don't store the commodity. And this is a fundamentally important issue. And I have to tell you this because I've been teaching this a long time. It was just 1 or 2 years ago, I talked with this exact same slide, and nobody wants to sort of ask a question in public, but he called me afterwards. And I just got done articulating, you know, we're in an inverted market, don't store the commodity, don't store the commodity. And today we're in an inverted market. He calls me up and says, you know, I'm still storing 2017 crop. What do you think? And we're in a big inverse and the market's saying, don't store. Well, there's a pretty long history behind this. I don't want to bog you down on this, but there is historical foundations to this. This on the right-hand side is a supply and demand for storage. That supply curve is kind of shaped kind of oddly, but if on the far left-hand side of it, you'll see that when stocks are really low, we gravitate towards a negative storage market, or what we call an inverted market. And that's where we are today in most commodities, but particularly soybeans followed by corn. We have extreme tight stocks. We've never been this tight. So we're as far to the left on that figure as possible. That would tell us that the equilibrium price of storage is negative or inverted. Here's where we are today. Well, I guess this is when I wrote the lecture, which was June 30th, but that shows the prices for different months going forward. And you can see that the difference between all of those are negative. And this shows that it's negative throughout the entire time period. So a very, very simple marketing strategy. We're inverted in the futures, basis, and the secondary rail car market. Don't store the commodity. And this would tell you to prescribe the best strategy is sell in the nearby. Well, this price of storage varies over time, but we've been persistently in this inversion between old crop, the 20 crop versus new crop 21. Second concept is the basis, and that's the difference between cash and futures prices. It used to be, it was a simple idea. You simply had cash and futures, and the difference was the basis. This is the way I like to articulate this now. In the cash market, we have both spot and forward cash markets. Futures markets, we have forward transactions. And the futures market has very standardized terms of trade. There's a prescribed destination, location, quality, and time of delivery. Whereas in the forward cash market, they're very specific. You might have specific location, specific time, specific quantity and quality requirements. So this difference between cash and futures is a little more complicated. And then in addition, the cash market is highly influenced by the rail market, which I'll talk about in a moment, which is both spot and forward. So generally speaking, futures and options are used for risk management, as Frayne talked about earlier. Cash market is used for making cash transactions. Difference between cash and futures is the basis. So the basis is impacted by the delivery mechanism. We say that the basis converges to the delivery charge during the delivery option month. It's influenced by shipping costs, storage costs, and quality premiums and discounts. So this is kind of our world famous diagram we use to explain all the time, that in concept, over time, the basis appreciates over time. At harvest time, the basis tends to be abnormally low, and then it increases in the black line going to the right. And during the delivery period, the basis is equal to the delivery charge at the delivery market. So at the delivery market here in Chicago for soybeans, the delivery charge is about 2 cents a bushel. So this says that the basis will follow that black line upwards theoretically. And technically, that slope of that line is equal to the reduced cost of storage as you get closer to the delivery option month. Now, in practice, and we've been studying this for many years, I'll show you some slides, it always doesn't behave the way it's expected to behave theoretically. And typically speaking, the basis behaves more like this blue line, where at harvest time, the basis goes to abnormally low levels. That's due to excessive farmer selling. Very excessive farmer selling relative to demand forces down the cash price, therefore forces down the basis. Eventually, the basis gets weak enough that people start buying the cash grain and storing the commodity. End users, maybe producers, maybe elevators. And then once that base, the grain is kind of locked up in storage, the basis appreciation has to accelerate. So it increases at an abnormally high rate relative to the cost of storage. And when it does that, it induces market participants to take grain out of storage. So that's more typically what we see in these markets. So we study bases to death, and I'm just going to show you these here, Jamestown, PNW, and Brazil, because they're so important to us right now. Here's the bases. Actually, we call this Jamestown, but when Ryan made the chart, this is from Air, North Dakota, because we have someone from Air speaking on the program in a few moments. So on the left-hand side shows the basis from 2012 until current. It's probably not to detect any obvious trends there, but that solid, bold red line shows the average. And in the current year, I don't know if you can see it here, but there's this gray line right there. That's the current year. So we would say today, in just about all markets, the basis is about 50 cents a bushel stronger than normal. So if the normal is the average, the basis is abnormally strong. Why? Well, the basis wants to get high to attract grain out of storage. That's what the basis is doing. You'll see some abnormally in those other years. I won't speak about them now. On the right-hand side shows the seasonal averages. And this is really an important punchline for those of you in North Dakota here. That red line shows the long-term average of that basis. What it shows is that the basis at harvest time in September and October is low. It goes up and reaches a peak in December and January. And then it reaches another peak. It declines during March, April. That's concurrent with the harvest in Brazil. Then it reaches another peak sometime in July or August, and then begins falling. So right now we would say fundamentally the basis, looking at new crops, should be declining, and will reach a low sometime in September and October. And then the basis will appreciate very rapidly and reach a peak in probably December, January, before the Brazilian harvest, and then it falls again. So what this tells you as a farmer, if you're marketing strictly on the basis, harvest and store at harvest time, store it until December, January, find the best time and location to deliver, sell it December, January, liquidate your position before the Brazilians begin their harvest. Here's the PNW basis. This is a longer period from 2012 until current. The top line is the PNW. The lower colored line is the basis at, I think that's at Jamestown. You can see they're kind of related to each other. Typically speaking, the basis of PNW would be about $1 a bushel. Think of that number. We had a spike in the past few weeks, which jammed it up to about $2.75. But there's such limited trade that it's really hard to know exactly what the basis is. On the lower left-hand side, I show the basis that ADM has used just a couple days ago for buying soybeans, and you'll see at the P&W there, their basis for new crop is about 158. So that's about a 50 to 60 cent basis higher than normal for new crop. So just remember that idea that the basis seemingly is going to be higher than normal as we go into the new crop. This is the current basis for US, P&W Gulf, and Brazil. And this is from a company called AgriSenses that we use in our trading room. That red line is the basis at the US Gulf. The purple line in the upper left is the basis at the P&W. That green and yellow line is the basis in Brazil, Santos and Paranaguá. To me, I think what's really important for you is our bases are kind of competitive with Brazil now because the Brazilian basis is very high. But as we get 5 months out, the Brazilian basis peaks out. That's December. And then after December, the basis in Brazil begins to fall and falls very sharply. I don't know what's going on there. The Brazilians are beginning to approach harvest. They're expecting a large harvest and a lot of harvest pressure because they need money. So they sell, and that forces the basis down. I believe what's important for you as farmers in North Dakota is look at that decline in the basis from M5 December until M8. That basis is going to fall $1.50 a bushel. So that's huge. And that's going to put tremendous downward pressure on basis values at the US Gulf and the P&W, and ultimately in center North Dakota. So that kind of tells us that, you know, December, early January in that area is going to be the time period prior to the basis crashing, which means it's probably the time you got to be looking at selling. So our freight market has a big impact on the basis values when we talk about the interior bases. We study this to death, and I spent a career of my time studying this. This basis is heavily impacted by rail velocity, by Chinese imports, and by the Brazilian basis. And the secondary market basis, secondary market is highly volatile. So here's a picture of secondary market, 2012 till current. You can see typically it's around zero or slightly above that. Periodically we get spikes up to $3,000 or $4,000 or $5,000 a car. That creates a lot of risk. On average, this basis is about this secondary car value is about plus $300 a car. Sometimes it goes to zero. Sometimes it goes below zero, but it rarely goes below zero, below $200, minus $200 a car, because that's the cancellation fee in the mechanism. So this shows a chart which I think is pretty important for us, is that it shows the bases at at Jamestown and at P&W, and at the top, the secondary car market value. So these are correlated to each other. And in the upper right-hand side, it shows that correlation. The basis is positively correlated at P&W to secondary car values with a value of 0.424. And at Jamestown, it's negatively correlated. So when the secondary car market values go up, it has a positive impact in the P&W and a negative impact in the interior. It has a greater positive impact on the P&W than it has a negative impact in the interior. So that's pretty important. So as look at new crop, we might have a secondary car value of $1,000 a car. That's probably going to have a negative impact in the country basis by about 15 cents a bushel. Here's the current market on secondary values. This is from Molson. In the nearby, there are negative values between $300, $400, $200 a car. That's a bid offer mechanism. But as we look at first half October, you look at that spread, it's bid at 500, offered at 1,000. On average, new crop October is about $800 a car. So secondary car market values are being offered at the historical average of that time period. Probably students of mine who did their class assignment on this, I said, well, that's the average. So we're looking at a pretty strong increase, more or less by about $1,000 a car between now and between now and October, which is about 26 cents a bushel. These other charts I won't discuss. It's another secondary broker, but I got to monitor my time. So we got to talk China, 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 and more China. So the Chinese imports have a huge impact and positive impact on the P&W basis. This is Chinese imports. You've seen this if you heard me speak. The red line is their imports. Fastest growth market in the world at about 18% a year. We're currently at about 100 million metric tons. WASDE has them going to 140 by 2030. Here's their imports by source. Red is Brazil, navy blue is the United States. You can see the effects of the trade war, but also the effects of the past few months where they've accelerated their purchases from the United States. You'll see these purchases are highly seasonal, and their amount they buy from Brazil versus the United States is highly seasonal. So this shows on the right-hand side the amount of coverage estimated that the Chinese currently have. I want to focus on the lower panel of that. This is as of last week, and it shows the amount of purchases they've acquired to date for new crop for September forward. You'll see that number 9%. That means for September, they bought 9% of the requirements. For October, they bought 38% of requirements. But take a look at December, January, they bought 0. That's a huge deal. If you want perspective, I would say, compared to history, China is very undercovered at the moment. At the moment, they've made about 12% of their purchases. Last year at this exact same time, they had made 35% of their purchases. So I'm guessing they're waiting for futures to fall and or for bases to fall and or for them to clean up their logistical situation because of the large amount of corn that they've bought. Nevertheless, they've got a lot of soybeans to buy, about 13 million tons for Jan that they've not yet bought, which will have an impact on these markets. I'm skipping some slides because I'm monitoring the time. I think Jenna's going to cut me off in 15 minutes. So, but these will be available online. This is how important China is to the United States and North Dakota. 72% of our exports go through the P&W, all of which goes to the Asian countries of China, Bangladesh, Taiwan, and Vietnam. And I'll show you later that trying to move soybeans away from the P&W is not at all profitable, and it probably won't happen, at least in the current regimen of rail rates and bases and demand. Okay, so I want to make a comment on looking at 2022 briefly on soybeans. Actually, I spoke on this yesterday in Chicago, but I think it's pretty insightful for us. We're going to have a major battle for acres in the spring planted regions, notably North Dakota, as we look at 2022. And the reason for that is the extreme reduced production of spring planted cereals, notably spring wheat, and the drought situation affecting soybeans. And my calculation says the market's got to attract about 1 million acres of spring wheat in North Dakota in 2022. So 1 million acres is about 20% increase. That's a lot. And so this chart on the left-hand side shows historical soybean Minneapolis futures price ratio. You can see in recent years, it's about, it kind of varies between 1.5 up to 2.5. It's been as low as 0.75 and it's been as high as 2.5. So when that ratio is very high, it's going to attract a lot of soybean acres. And we'll see a diversion from spring wheat to soybeans. When that price ratio is low, it's going to attract more spring wheat acres. Now, to me, it's pretty interesting that you see on the far right-hand side of the left-hand figure, we peaked out at about 2.4 something in that area, 2.4 a few weeks ago, which would have made it very attractive for soybeans in 2022. But now in recent days, that's declined approaching 1.5, which will make it more attractive for spring planted wheats. Well, you're all farming and growing both of these, so you know these budget matters. Historically speaking, the left-hand side of this figure shows North Dakota spring wheat planted acres. The green line is soybean acres, and you can see that the spring wheat's been declining, soybeans are increasing, and we're at record high this current year. I'd say we don't have a lot of history where we reverse these trends. So I think the market's got a lot to do to take grain out of soybeans and put into spring wheat for next year. Brazil has a huge impact on this basis market. I'll make a few comments on it. So this shows the historical basis at Brazil, which would be the yellow and red, yellow line. Argentina is a blue line, Gulf is a red line, and PNW is the top line. So you can see there's a lot of seasonality here. Back in about 2019, after the trade war, you can see that those were highly competitive. But in the recent right-hand side, you can see there's a high degree of variability there. So that's what we spent a lot of time looking at, is how competitive our basis is. Here is from McDonald-Pelz just from last Friday. So I hope you can read these. But the top row shows the bases at the US Gulf. This would be FOB at about 115, 110, 112. And then P&W for September at 253, 190 for October. Now, interestingly, the track price for October is 158. So this is the estimated FOB value at 190. So that's a pretty wide margin or spread. But to me, what's really important for you is this basis in Brazil in November and December is 159, and it falls into February at 38. So that's $1.50 to $1.20 decline in the Brazilian basis, which will put downward pressure on our basis. Here's a history of the Brazilian basis. Again, the solid red line shows their average basis over time. Their basis is very low between Feb, March, April, May, which is their harvest period. Then it increases very sharply and reaches a peak in July, August, September, and then begins declining. The height of that peak and the length of that peak is highly dependent upon their crop size. Now, in the top part of this figure, you can see the same graph, but it shows each individual years, but that royal blue line on the bottom is their current basis. So you can see that their basis is abnormally low relative to normal. So it's abnormally low relative to normal. And that's reflecting the competitive environment, the size of their large crop, and some waiting time demurrage, which I'll speak to in a moment. So waiting time in Brazil is one of their most critical things that goes on that affects this basis market. This shows the average waiting time by month from July 13 until current. So go back in those days, 2013, if the average waiting time is 15 or 20 days, that means the ship is going to wait 15 or 20 days. That means they're going to pay demurrage at $10,000 or $15,000 a day for that period of time, which is very costly, and it's been their nightmare. But they've been spending $1 zillion lately trying to improve that, and you can see how it's improved through this last fall, 2020, when they fell down to about 5 days waiting time, which was virtually nothing to be comparable to the United States. But in the spring of this year, they had a trucker strike and a number of other things which forced ships to be backed up and had the negative impact on their bases because ships were backed up, which increased their waiting time. So that's a pretty important variable to monitor if you can. I just want to make a comment that sometimes people say, well, why don't we ship to the US Gulf? And this chart shows the economics of shipping from Jamestown to P&W versus St. Louis. And it shows the bases at St. Louis and P&W current, the shipping costs, the net price Jamestown, and what it tells the Jamestown handler, he can get a gross return of 90 cents going to P&W and only 18 cents to St. Louis. That's just about always the case. And that really means that virtually all of North Dakota soybeans will go to P&W, and only rarely will a little bit dribble out elsewhere. So people ask me, and I'm trying to draw closure here, is, how do you analyze all of this? And I'll give you a few tools that we use. First of all, we pay a lot of attention to inversions. inversions I discussed in the case of futures basis and freight, and well as seasonal behavior of the basis. The seasonal behavior of the basis is very, very predictable. So we make projections using MACD and seasonal indexes. So Frayne illustrated to you on DTN how they use MACD on futures. And what MACD is doing is providing a prediction of a turning point. And if there's a turning point, it tells there's a turning point in the market. But we can apply the same exact methodology to the basis. And in fact, we do that in DTN and in all the other data, digital media that we have here. And to me, what's important there, we can kind of tell, is the basis going up? Great, we know it's going up. We want to know, has it peaked out or not? Probably the best indicator for that is MACD. This illustrates the mechanics of that. Here's P&W soybeans from a year ago. So you can kind of see here, and this applies to bases. This is done with a click of a button on DTN, or if you use my DTN, same thing. So you can, if you can kind of see here in about July 20, the basis was about 95 over, and then it started increasing. And you can see we got exactly that indicator here on July 20. And it stayed strong. As you can see here, we got another strong upside movement in this time period around the first part of September 2020. And then the basis went up to about 155. So that illustrates how the MACD provides an indication of the direction of change in the basis. So here's Courtney, North Dakota, just by Jamestown. And this is continuous from July 19 until current. I just want to highlight a few points here. You can see right at the very beginning here, July 19, we had a declining MACD. Those negative bars in the distribution says it's declining, and the basis is declining. And then right at that time in early September, it seems as though it was hitting a price floor, and the basis actually hit a price floor. And then it increased, the MACD increased, and indicated here by about early November, the basis was reaching a top. And in fact, it began to decline thereafter. Now, in the past few months, since about March, we've had a lot of volatility in this basis because of all the things going on in the world marketplace. And that's reflected in the basis. You can see here that a few weeks ago, we got a pretty sharp declining basis indicator, then a sharp increasing basis. Right now, it's appearing as if it wants to become a negatively sloped basis. Here's a Courtney new crop basis looking at, I think this is September new crop basis. And you can see it's pretty flat over a long period of time. We have some volatility there, but we got some increasing indicator here just before the 1st of July. And that's continuing to be increasing at the moment. But as I told you, we get a peak in that basis in July, and then it begins to decline into September. So we should be monitoring that very closely as to whether or not we get a negative turning signal. So we're pretty big on seasonal indexes, and we derive these for all of the commodities. And these are the seasonal indexes for the bases in Jamestown. So this shows, you can tell by looking at it that the base, that red line is the average. So the interpretation of that number, it says that the basis here, I think this is on, this may be a mistake. I'm pretty sure this is on wheat because it shows a decline into December. So let me just skip that. I think that's an error on my part. So just in dry enclosure, this is the chart I use. Frayne uses one similar to that, but it shows we have two fundamental factors impacting farmer decisions about marketing. One is the basis of spreads. The other is futures. And what choice of contract and marketing strategy you use is highly dependent upon how you expect that basis of spread to change, how you expect the futures to change. Looking forward, if you want to look for me, I'd say there's going to be downward pressure on the basis sometime as we get into late July, August. as we approach the new crop in the northern tier. So there's gonna be some downward pressure on the basis. Remember, the base is already 50 or 60 cents higher than normal. So there's probably more downward potential than upside potential. On the other hand, Frayne probably built a pretty bullish outlook on soybeans, or a kind of bullish outlook on soybean futures. So there's probably some upside potential in soybean futures. And taken together, that says that probably the best strategy is a basis contract. Well, those are the crucial variables to monitor to do that. So this is just the last slide I'll use, and then I'll draw a closure. I'd use this in my class, and Brock Associates put this together on Central Illinois soybeans about when is the seasonality of bases lowest and highest. And you'll see here what this shows is in Central Illinois. This is about true in North Dakota. The basis is strongest there during August, September, and October. Then looking beyond there, it goes to a decline. So then what that tells you in that part of the country, the best time of the month, best month of the year to be selling soybeans is really October. And then you never want to start beyond October, because you start, in that case, approaching corn. But as we get into Jan, Feb, March, we're approaching Brazilian harvest. So I'm going to skip this because of the time. So let me just give a final summary outlook. We have extreme interventions in the markets nowadays, causing more volatility than we've seen in recent years. That means lots of risk. Notably important for our old crop is drought, as you're all familiar with more than anybody else. Drought not only in North Dakota, but in Canada. We have this scenario we call short crops have long tails, which is probably pretty vivid. You know, in the case of soybeans, last time this happened was in 2012, and the futures market peaked on July 9th and then stayed there for about 3 or 4 weeks. And then it declined very sharply after September. And I'm talking a very, very sharp crash. But related to this is FSU growing conditions, which has been having some problems in the past few days. I think a major risk in the case of soybeans is, of course, China. As I told you, they have made very spotty purchases so far for the coming crop year. And how and when and where they buy soybeans as we look into the end of, or the beginning of 21 crop year into 2022 will have a big impact on this basis market. Futures prices pretty strong right now by historical standards. We'd say fundamentally they're about where they should be, maybe a little bit of upside potential. Probably it could go very much higher than that, but it's hard to predict that because we've never experienced that. However, the basis is notably pretty high right now, probably greater downside potential once we get beyond the end of July. So with that, Jenna, I will stop share and take a few moments to answer questions before our guest speaker.
All right, well, thank you, Bill. I'm not seeing any questions in the Q&A or in the chat, but if anyone has any questions about the basis presentation that Dr. Wilson just gave, I'd be happy to pass those on to him. I am impressed at your ability to be perfectly on time, Bill.
This is my third presentation in 2 days, so.
Okay. We do have a question from Monty
Ocean
Peterson
freight
in
rates.
the chat.
So
on
for
ocean freight
perspective, for perspective to the audience, Monty obviously knows this, but ocean freight rates have doubled in the past year. In the past year, ocean freight rates have doubled. It's a monster impact. Ocean freights, just for your perspective, 70% of the cost of ocean shipping is oil. So oil prices went from -20 to +75. So that is all being reflected in the cost of ocean shipping costs, notwithstanding the escalation in demand and the congestion that's accruing in the ocean liner business. So ocean shipping has escalated to be very important. I don't want to say ironically, but we're studying this very carefully right now. We developed a very elaborate model that covers all of this, but what's important for us is the cheapest ocean rates in the world going to the biggest market in the world are from the Pacific Northwest. So all ocean rates have gone up, but if ocean rates go up by 50 or 70%, it has a lesser impact on the Pacific Northwest than on the US Gulf or than on Brazil. So that's very favorable for P&W shipping. And we believe, and in our models, it illustrates a pretty substantive increase in the demand for shipping out of the Pacific Northwest. Monty, we're studying that pretty intently, and I'm going to share it with Jenna and Stephanie on August 10th. We'll come back to that.
We do have a
So
question
I can-
also about how the crush plant will affect basis and how soon will we see that affect basis?
Well, it's, I'm guessing there's 2 or 3 years of construction, so probably not till after then. We don't know for sure, but remember a few years ago at this exact same seminar, we had a speaker from ADM speaking about soybeans, and he talked about Enderlin. And he showed a chart showing the average basis over time at Enderlin versus the average of the nearby shuttle elevators. And that number was exactly 20 cents. Frayne and I immediately went to GeoGrain, which we have in the trading room, replicated the chart. That number was exactly 20 cents. So if I were to guess and put a number on it to go to bat with, I would venture to guess, you know, ADM is not going to pay more than they have to get beans, but they got to make sure they run that plant 24/7. Seems as though in their other market areas, they're paying about a 20-cent premium relative to nearby shuttle competitors. My guess would be that is what we will see in the Spiritwood plant.
Great. Any other questions? Dr. Wilson. All right, well, seeing
Okay.
none, thank
Thank
you.
you.
And
I'll be staying on and can answer questions
perfect.
later if appropriate.
Perfect, thank you.
Yep.
Well, with that, to provide an industry outlook into the next marketing season, Brent Roberts from the Arthur Companies is with us today. Brent is general manager for the Arthur Companies in Harvey. He has recently joined Arthur Companies, but he did trade P&W corn and soybeans for over 10 years before moving to North Dakota. So with that, Brent, I will yield the floor to you. And we see your slides.
Okay.
You can go ahead, thanks.
Thank you very much. I don't want to obviously beat a dead horse, but we've got some corresponding slides here. What I'm going to offer out there, and I will also offer out some personal opinions and what I've heard from others. So first thing I wanted to talk about was grain stocks. It's a big deal, obviously, and it's been touched on before, but the biggest thing I wanted to highlight was the fact that this on-farm storage here just in North Dakota is at 6.2 million. That's what's reported. And in 2020 or the 2021 off-farm is at 14.1. So you can see a significant decrease in the amount of soybeans available here in North Dakota. Obviously, we had a lot of PP acres out here, so that is a direct representation. It's also had an impact on prices, obviously, here recently. So that's something to keep an eye on as we move forward. How is this going to change next year and this drought situation that we're currently in? This is a USDA soybean prices per year. As you can see, we've started to creep back up. Obviously, 18 and 19 were during the trade war years. Values were kind of held up by some Chinese buying, but also other buyers who came to the U.S. when South America was swamped with the Chinese business. We saw some historically different. Uh-oh, did you guys lose me?
No, we still have you. We just
That's
lost
weird,
that slide. Right now we can see it in
And
kind
the
of the
presentation
two-screen.
mode.
Yes.
Yeah. Hang on here. I don't know what happened.
Yeah, maybe if you hit that swap.
Now, which one are we on?
I see the prices per year.
Okay, perfect. Okay, we're back to it. Gotta love technology. So as I was saying, the 1819, we obviously saw some interesting buyers that we didn't historically see. We're starting to see a little bit of an uptrend again. The reason I went back to 2012, very similar type carryout numbers now that the USDA is giving us to trade on going into this 21-22 season. So we're kind of on that same trajectory. There's one thing I wanted to touch on the acres planted. Again, like Dr. Frayne said, you may not agree with these numbers, but these are the numbers that we need to trade. The huge increase here in North Dakota from last year to this year, again, PP acres makes a difference, but we're seeing a gigantic increase here. And that's something that a lot in the industry, especially the P&W, they're paying attention to, but maybe some others are not. So just something to kind of keep a focus on. If I was in the export business, I would have thought to myself, hey, huge acres in North Dakota, South Dakota, and Minnesota, which are all historic movement to the West Coast for the most part. And you would think lots of acres equals lots of bushels, which equals lower prices. But wait, what happened? We're in this drought. This is as of July 6th. Again, I'm sure this will be touched on more in this from our next presenter, who's going to be talking about weather. I don't need to dig too deep into that, but currently just in North Dakota, we're seeing some pretty exceptional drought in certain areas, and it is definitely reflective when you go out and take a drive around the state compared to what we have historically seen. So I want to put this up here. This is something that, you know, in 2012 wasn't as big of a importance as it currently is, and that's social media. Social media can move a market, and all buyers are watching. Whether or not you know they're there or not, they are watching. So these are some photos that have recently been put out there by Karen Braun on Twitter. I snagged them off of Twitter. I thought it was pretty interesting. You know, you can see that right away, Iowa, Indiana, they look incredible. Western Iowa looks not as good as Eastern Iowa. You look at Minnesota, looks pretty good too, right? Well, us here in North Dakota, we see things a little differently. And depending upon where you are, it could look much worse than it does there on that one. Again, Western Illinois probably getting the rain that we would love to have right now, but maybe too much for them, as noted there by the pictures. So again, social media, something that can move a market, and it can move a market rather quickly. So as Dr. Bill just talked about China, right? So China's purchases, $26.5 billion in 2020 in U.S. agricultural exports. They are the #1 buyer. So it's hard to say that they can't move a market, because they absolutely can. Not only can they move a basis value, but they can also move futures, and quite rapidly. We've noticed a huge growth in export from them. In fact, 40% increase just from 2011 to 2012. But when you notice, I don't have the chart up here, but if you can find the chart online, there was, of course, that big dip in 2018 and 19. It was that short-term pain for long-term gain, theoretically, and hopefully that continues to be the case. Thus far, reportedly, known China purchases of soybeans from the US for 21-22 are at 4.1 million metric ton. Unknown, which a lot of people, myself included, will say is a majority of China, is at 3.4 million metric ton that's already purchased. So we're looking at 7.5 million metric ton. Not huge, but again, Dr. Bill showed that China has not bought a lot of their December type time frame. They did come in quite early this year, buying October, late September, early October, and even into November, in that January and February and March time frame before they exited before they left the market. They've been sitting quietly waiting. Why did they do that? Crush margins were incredibly good during that time frame. So they were buying based upon that expectation that they were going to stay there. Obviously, as that crush margin has backed off, so has their buying. Typically, China is a 90 to 120 day out buyer, at least in the last 5 or 6 years. What that means is they basically buy 120 days in advance. So we're coming up on them looking to be a buyer for that late November, early December timeframe. And I was talking to Dr. Frayne a little bit earlier. There was some reported chatter of potential buying just yesterday and the day before. Was China buying soybeans in the market? Were they buying from the USP&W? Were they buying from the Gulf? It's actually what I kind of heard is that they were buying some late summer bushels from Brazil. So again, I've been told also that there's an additional 3 to 4 million metric ton that is thought to have traded but not flashed. So what do I mean by flashed? Typically, it's only over 120,000 metric ton has to be flashed if it's sold in a day. Some of this stuff is kept internally, right? COFCO, Sinograin, they're the bigger buyers for China. They're the Chinese governmental buyers. There is a U.S. COFCO entity in Chicago. They don't necessarily show all of their purchases and stuff, and I know it's kind of an odd situation, but because they have an overseas arm in Geneva, they can kind of quote unquote hide purchases. It's not really, they're not really hiding, they're just not publication. So something that people need to keep an eye on and watch for. With the chatter, where there's smoke, there's usually fire. So South American soybeans, this year's recent weather in South America has created some reported quality issues. You know, historically, South America is by far and away the best quality of soybeans in the world. And right now we're hearing about some issues that maybe they aren't so good this year. I don't think that they're terrible, obviously, but there is some recent reductions here, not only in Argentina, but in Brazil that was made by the USDA. And the USDA is leading that saying, well, it's weakness in the Chinese crush, which has decreased Brazilian soybean demand. I say all it is probably just their quality. China wants to wait and see what the US quality looks like, and they'll probably do either a blend or they'll continue buying from one or the other. China is going to buy, they're going to crush. Their demand, it seems like, in my opinion, is not going away anytime soon. So we should continue to see quite a decent demand from China, especially as they focus on their phase 2 of the trade agreement. Again, something to think about with South American soybeans, overall ending stocks for Argentina and Brazil are both expected to be higher. That's just their carry out. And a lot of that is based upon the weakness in the exported amount. So how about US domestic forecast and expectation? Well, the domestic use so far has been recently lowered by the USDA. But export demand for meal has been strong and continues to remain strong. In fact, I believe there were some recent sales just this week. So it shows that there is going to be that continued demand as we look for feed for around the world. And then you've got soybean oil. That export demand has just been on fire. Recent pullbacks here recently have led to some price easing, and we should see that potentially pick back up as not only the US, but the rest of the world reopens going forward. US export and movement expectations. So China's demand for soybeans and corn are going to kind of interweave here this next year. That we saw this last year. China bought more corn out of the US than they had, I believe it was a historic level, if I remember right. And because of that, some of that timing had to cross historically off the PNW as well as the Gulf. Soybeans usually trade out of late September through early March. This last year, soybeans still went into early March, but the demand was very heavy, actually late August, early September, October, November, and then it faded off. But we saw a lot of people selling corn and soybeans at the same time, which a lot of people, especially in the PNW, don't like to do. It becomes a logistic nightmare and a headache. So they took the chance. They sold November corn, December corn, and then really ramped it up, say late January, to where it was, the spring was the largest spring on record out of the PNW as well as the Gulf. When I was trading off the PNW, I had a lot of contacts there in the Gulf, and one of them specifically said it was the largest spring program and summer program that he'd ever been a part of, and he'd been in the industry for a long time. So China was a very large buyer of corn. Personally, I believe that they are going to continue to be a large buyer of the corn over the next 2 to 3 years out of the US. Obviously, depending upon quality, they are a quality buyer. They like to buy US 2s. But China had 55 million metric ton in state reserves. And they actually sold that or auctioned off that 55 million metric ton this last year because their domestic price was at an all-time high, and their domestic production was hammered last year by a couple of storms that wiped out much of that northern portion of their crop. So China got rid of a lot of their, well, they zeroed it out from what we can tell or what I've seen, and now they're going to rebuild those stocks. At one point last year, there was some, I guess you could call it propaganda, whatever you'd like, but the Chinese government put out an article that they felt that the world was going to be in a food deficit situation by 2025. Now, when you have the world's largest population, you also have to have the world's largest stockholds or storage. So China is going to replace that 55 million metric ton, and you're not going to be able to do it in 1 year. People will say, now Brent, they buy from other people, and you're right, they do. They buy from the Black Sea, they buy from South Africa. They don't right now buy from Brazil and Argentina because there is some phytosanitary certificate issues. They are in talks with Brazil and Argentina on how they can get through those. But with China making such a drastic amount of investment dollar-wise in South American logistics, I anticipate that they will get that phytosanitary certificate issue finalized and put behind them. Obviously, when you're working with the world's lowest cost producer, you want to buy the lowest cost product, but I wouldn't expect to see that for another 6 months to a year here. So it could give the opportunity for this year for the US to be that major movement for China. I suspect that we'll see anywhere between 20 to 25 million metric tons sold to China over the next year to 2 years, in addition to the 20 plus million metric ton that was sold this last year. Rail movement, barges. Currently, there's 155 or 153 to 155 BN shuttles that have been sold for OND and first period January. That reduces as we get into late Jan or middle Jan into April, down into that 148 to 142 range. You can obviously see it goes high and it slowly tails off. A lot of that is because the anticipated movements that they were expecting on soybeans. The BN did their auction quite early in the year. Great move for the BN BN itself. Bad for those who now own freight and maybe are sitting in North Dakota potentially. Again, and I think all elevator managers are going to try and keep a positive thought and say, hey, record acreage planted. We're still going to get a lot of movement. I'm one of those folks who thinks we're still going to get a lot of bushels to handle. We just hope that we can get them out of the hands or out of the bins there and get you guys good prices. So as we go forward, the BN will auction off more. I think there's a lot of hesitation. The BN sees what's going on with the weather, and they've backed off. They haven't put out a lot of those auctions here recently for that January forward position. As for the CP, the Canadian Pacific Railway here covers a good portion of North Dakota. The Canadian crop right now and how that will be reduced is going to have a drastic impact on the CP, but also North Dakota itself. So there could be quite a bit of rail availability on the CP that we haven't seen in the last couple of years. That being said, how are we going to see movement in itself? Anticipate a smaller amount of volume coming out of North Dakota, South Dakota, and Minnesota than maybe what we saw or maybe what we could have seen. And they're going to have to go to some of those non-traditional locations. They're going to have to buy from the Nebraskas and the Iowas of the world. The eastern Minnesota might work west rather than working to down to St. Louis. There is some low water level situations in Minnesota That could affect barge movement moving south. Will they have to take some of those BN shuttles, CP shuttles, and move them down to St. Louis? That's a very good potential. That also creates some delays on those railways. The non-traditional locations, the Nebraska's take an extra 2, maybe 3 days to move west. That in itself could create some waiting. So although we've seen secondary rail freight values decreasing, because I think a lot of people are concerned there's not enough crop to handle. Well, the question is, how much slower will the trains be as we increase movement from non-traditional origins? But also, we see an increase in the amount of oil cars, intermodal cars as the US reopens and people start to buy things again. So you could see some reduction in efficiency that we didn't see last year. The efficiency on the railroad was absolutely incredible last year. They almost ran the P&W over, even though there was a large program. The vessels themselves couldn't keep up. Again, current 2021 exports to China are at 10.72 million met ton on soybeans through June. And I suspect that we're going to see very similar type numbers out of the P&W as vessel freight values, as Dr. Bill said, vessel freight values, from what I've heard, US to P&W have more than doubled. They used to, I would say last year about this time, it was $21 per metric ton to move it from the US P&W to China. It's roughly around $46 to $48 per metric ton. The good news is the freight spread itself has also widened out, which is going to give the P&W the opportunity to still maintain the competitiveness while having a higher basis level. It'll give them some opportunities to trade that way. Just is kind of again, just a quick chart on the buying trends of China. You can see October, November, December are the very big heavy months, and then it quickly tails off. Key takeaways, weather. That's obviously at the forefront of our mind. We took the weather market seemingly out of this thing after the 4th of July. Now it's quickly back into it with the extended period looking pretty rough. And I think our next speaker will touch on that. US production is a big thing. Do we start to see Twitter reports, hey, things are looking better? How does that affect the market? Again, like I said, social media can have a huge impact. So, you know, as odd as it sounds, pay attention to it. Futures resistance in the soybeans, again, that 1380 to 1420 level, that seems to be the resistance. If we can close above those levels, it'll be interesting to see where we go. But with the carryout potentially being similar to what we saw at the end of 2012, could we see those 2012 values creep back into the markets? I think that there's a very good possibility as obviously wheat continues to try and draw. They're going to have to try and buy some bushels or some acres back. Those values might have to increase. Soybeans and corn are going to continue to try and run with them. Other oil seeds, specifically canola, especially in Canada, how is that going to be affected if the canola production does decline without the significant rainfall that it's going to need? How is that going to affect the overall market? China is a huge buyer of Canadian canola. Will they look to replace it with something else? Potentially even cotton. So something that needs to be kept an eye on. Also, the EU specifically, their canola production was recently cut as they're starting to see some weather issues as well. Chinese soybean demand, we've hammered on that thing. Chinese crush margin, interior crush margin, that will have a play on your domestic movement here. Typically, the later on in the year, your marches forward, we see a lot of movement east into those domestic crush markets out of the North Dakota, South Dakota, Minnesota region. And again, oil meal and demand domestically and abroad. I think from me, that is all I've got. Is there any questions?
All right, I'm not seeing any, Brent, in the Q&A or the chat at this time, but we'll see what comes in here. I've never thought about social media's impact on the markets before, but you're totally right. I made a Twitter to follow Karen Braun because she just is the greatest when it comes to markets. And I always recommend that people follow her.
It's incredible the amount of, I guess, the amount of chatter that's created by a picture or two. I used to do a crop tour, and I would post pictures on Twitter, and I would always get people that would send me messages and say, "You only show the best quality. Why don't you show us the worst as well?" And so my focus was, I will show you the good, the best, and or the good, the better, the ugly, whatever you want to call it. So I always did that, and I garnered a lot of those international followers, and that's when it made me realize this can move a market.
Yeah, it's amazing. Well, I'm not seeing anything come through now, but hopefully you can hang with us, Brent, through the end here. And if anything comes up, I'll send it your way.
Sounds great. Thank you.
All right. Well, finally, today we will end with hopefully some answers to the questions you've all been wondering, which is what can we expect from weather for the rest of the growing season? So we do have meteorologist Mark Ewens here to provide his perspective on that question. Mark is the staff meteorologist at KNOX out of Grand Forks, but prior to that, Mark worked for the National Weather Service. So with that, Mark, you can begin your presentation. We'll get your slide all set up if you are ready. Do we have you, Mark?
Yes, I'm unmuting, and I'm going to start the presentation, and then I will start. Let me see. I guess I can start my video. I don't know. I try to keep the video hidden because I don't want people to see. I don't want to scare anybody. Let's see. Okay, I forgot to share my screen. Yeah, it's been a while since I've done a Zoom meeting, so bear with me, folks.
And they're all a little different depending on how you set them up. So
yeah, okay. All right, so all righty, I think
we see your slides. They're not in presentation mode yet, but we do see your slides.
yeah.
Should be able to hit from beginning there.
That's what I did, and nothing seen. Oh, there.
Oh, okay, looks good.
Okay, now you can see it.
We can.
Very good. Okay, thank you for your patience, folks. As stated, there I am, the former National Weather Service employee, former Air Force weather, lived in the Red River Valley for the last 40 years or so. And again, thank you very much for having me here today. I wish I did have better news. Unfortunately, the forecast is not looking good. I do like to give a little overview for those of you perhaps who have seen my presentations. And if there are any questions, it's a little different, obviously, when it's not live, that you can raise your hand or work with Jenna and we'll get those questions to me in real time. I like to be interactive, so doing it via Zoom is a bit less exciting, as it were. I like to start off by talking about when we discuss climate in the weather world, we do data by division. Many of you may be familiar with this map. This is the climate divisions for the state of North Dakota. By design many years ago, the entire United States, every state is broken down within climate divisions. In theory, each one of these climate divisions have approximately homogeneous weather over the long term. Obviously, we know climate, I should say, we know that weather is very, very discrete in a lot of instances. So even though you may have significant rain, say in McIntosh County, Logan County can remain dry. So when we talk about divisional data, I talk about averages because a lot of the averages. I like to get my pseudo-political comments out of the way because everyone wants to talk about climate change. Well, obviously climate change is real. The climate has to change. It's not static, but very dynamic. I like to define climate in the sense of baseball, where the RBI is the actual climate and how the batter does at bat is weather. So that's kind of the variability for those of you who like that particular sport. The science of climate change has become very politicized, obviously, which muddies the waters. It's far more complex than 30-second sound bites can portray. Human activity certainly is a factor, but there are many other that are coming into play, and we're learning more about it. Solar cycles in of themselves have a little impact. I always get that question when I'm on the air. Is it the solar cycles? Because that was a popular theory in the 70s. No, but we've found out that solar magnetism seems to have an impact. And that's kind of a new development that is still being researched. CO2, H2O, methane, nitrous oxide, oxygen, they're all greenhouse gases. From an IR standpoint, water vapor is approximately 10 times more potent than carbon dioxide, but carbon dioxide has a lot longer latency. So all the gases have to be taken into consideration. Long-term climate cycles, we live in the temperate mid-latitudes. So by default, our climate consistency flips from wet to dry with inconsistency. That's just a part of the way the circulations work in our sphere, spinning around the sun, spinning through space, and differentially heated and cooled. Direct measurements of climate vary in time, density, consistency of measurements, requiring proxies to add to the database. So we'll talk about that. I've heard satellite data mentioned. I'll touch on that as well. A lot of the other information that you don't necessarily think is going into climate, such as river gauge data. I've got a slide that talks about that. Rural versus urban influences. Where is the warming? I didn't put the slides in, but I can show you the rural temperature data, which has been basically flat while the urban areas have warmed. So of course the net change is positive, but is it everywhere? No. Let's talk about normal climate for a minute, because that's a misnomer. There is no such thing as normal in climate. It's the variability. This is the daily temperature for last year, the Grand Forks area from the XM ACES system, which is an automated system that collates and types data and automatically puts it in a presentation or statistical analysis form. It's a handy tool, and this is actually available to the general public. It's a part of the Regional Climate Center out of Lincoln, Nebraska, in cooperation with the National Weather Service and state climatologists. The red and blue areas, the red on the top being the record highs and lows for record highs for individual days, the blues, the record lows. And this is just weather. This is just our normal climate. The banded area represents the normal high and low temperatures. So you just get an idea. And I think we all know this, that that's weather. Now, analyzing the drought, that was discussed. I believe Frayne talked about that. The USDM is a popular tool, but to understand it, it synthesizes data from a wide variety of inputs, state climatologists, weather service extension agents, hydrologists. Mentioned the Vegetation Health Index, which is from several different satellites, including GOES, the MEDOSTAT, the MSTAT, and the Defense Military satellites as well. It's a 4-kilometer grid. It uses a couple of different derived parameters that have improved greatly. So it's observed and modeled soil moisture that goes into it, runoff, evapotranspiration. It's a whole series of parameterizations, and then human input. The observers who report the data to the state climatologists. The state climatologists take the data also from county agents. Everything gets bubbled up into this. So the VHI, another high res 4-kilometer, 2.5 statute miles data, can give some specificity, but the big thing is that the USDM is designed as a general picture. Keep that in mind, because obviously conditions will vary. And the big thing is to get involved. You can contact Dr. Recuse at NDSU. If you're in Minnesota by chance, Dr. Luigi over at the University of Minnesota DNR office, or Laura Edwards down in SDSU if you happen to have land in South Dakota. They love to hear from the ag community. It's how they get their information put together. So predicting drought, it's kind of like maybe predicting how my 3-year-old grandson is going to react on any given day. It gets to be a challenge. There are layers upon layers and cycles upon cycles and time scales. So we actually have 4 categories of drought: hydrologic, agricultural, meteorological, and then the socioeconomic. Or I call that the drought in the media, that when people start to take notice, then it becomes a big thing. Like wet cycles, droughts are a part of the self-replicating and self-sustaining cycles of nature, but they are poorly understood. A lot of connections to the ocean atmosphere, solar terrestrial forcings have hampered our ability to predict the onset and dissipation of droughts and wet cycles. So we resort to history. So history remains kind of the primary guide with computer and statistical models as tools to help us understand the genesis and the dissipation of droughts and then forecasting them. So it's a process that we're learning more. I often equate my science to the medical sciences when they were first opening cadavers, looking at the heart, the lungs, the kidneys, the spleen, and going, what do these things do? How do they interact with one another? Well, that's kind of where the climate sciences are right now. We're going, oh, there's a lot more to this than we originally thought. So while global warming has occurred, there are actually large areas of cooling. The great Midwestern cooling plume, which I'll show in a minute, is sort of a mystery as to why that's happened. Most of the warming north of 60 degrees, obviously the polar areas have warmed the greatest. Oceans and land warming is very uneven. The mid-continent cooling, they believe, is a feedback from agricultural practices and changes, but that's yet to be proven. So think about it in the Red River Valley in North Dakota as a whole, we have seen fewer major heat waves up until recently, and we've seen fewer major cold snaps. The high temperatures have been generally coming down, the maximums, and the nighttime lows have generally been coming up. So it's interesting. So do these warmer nights and less hot days impact crop development? I ask every agricultural group that. How does the change in accumulating growing degree days, how does that affect things? So obviously by nature, agriculture is eco-friendly, so, you know, and not a climate change culprit that I hear some people say. Now, these are the new 30-year normals. Every 30 years, the National Climate Center, now the National Centers for Environmental Information, publish these maps. So here's the annual mean temperature change, annual precipitation change from 91 to 2020. And excuse me, I said 21 in my title, it should be to 2020. So you can see that these are the variances between the previous 30 years. Annual precipitation on balance has increased across the northern and central plains and through the Midwest. And there's that area of cooling, eastern Montana into North Dakota, down South Dakota towards Iowa, or less warming, with the greatest warming across the southern plains into the eastern United States. And so again, that's kind of a mystery as to how that has happened. Some of it they believe is agriculture, some tied to precipitation, because you can see the broad correlation where the warming is least or slight cooling ties to the heavier precipitation. Now, this is north central North Dakota, the climate divisions I mentioned. This are the two climate divisions that make up north central North Dakota. Just as an aggregate, I talk about the trends and how we use statistical data to kind of help predict climate change. The dirty 30s and the relatively dry periods getting into the 40s and early 50s where we became wetter again shows up. The variability line is the annual precipitation. Then there's a period of record mean. There's also a 7-year running mean in there. And then the polynomial, there's a polynomial tool that we use to kind of help determine whether we're headed in or out of a drought. And you can look since roughly 2010, the polynomial curve has been pointing downward. So the drought we're entering, we're kind of on the front end of that particular drought. You can look back in the 1930s, excuse me, back at the turn of the previous century where the precipitation, the polynomial curve started to go down. Now the data density has increased quite a bit as well too. So we had less data prior to roughly 1950 across the region to calculate precipitation. So there's a lot of statistical challenges that come up with using data sets. Same basic picture. This is the Red River Basin precipitation, the aggregate of the 5 climate divisions that make up the Red River Valley, Minnesota, and North Dakota. We see the same basic thing. The tool suggests that while the 7-year running mean precipitation has been going up, the forecast tool is definitely taking a downward swing. And here we are. Quick alphabet soup. Meteorologists like to throw out these terms: Pacific Decadal Oscillation. You've heard about El Nino, La Nina. Madden-Julian Oscillation, anybody? How about the Atlantic Multidecadal Oscillation or the Indian Ocean Dipole? The graphic here shows tied to sea surface temperature distributions, and these are departures from normal against the 81 to 2010 climatology, and this will be updated as well. But these graphics are what we look at to figure out what is driving the large-scale climate. For example, this winter, we had a fairly modest La Nina going on. La Ninas typically give us colder and wetter winters. Well, obviously that didn't pan out, and I'll touch a little more on that. It has to do with the very strong warm pool in the Pacific. And these are things we're finding out how very sensitive the climate actually is to the location of these maximum and minimum warm and cold pools. 2019 satellite imagery from the GOES-17 satellite centered out over the Hawaiian Islands, approximately near the equator. A year ago, the atmospheric rivers were very dominant. The upper left-hand corner image shows a fairly robust flow of moisture through the tropical Pacific into the southwestern United States. This year, very little flow into the western United States. And trying to understand how the changes in the Pacific thermal distributions have made this occur has become the real challenge, because again, they're complex interactions between all of the signals. Short-term climate drivers, and short-term we talk about monthly and quarterly, versus long-term climate drivers, annual, multi-decadal. That interactions, they're fairly well defined how they interact, but how they interact with each other is still a question. A significant portion of the climate prediction is based on history, causation and response. Some climate regimes are amplified, constructively forced, and some are mitigated, destructively forced by other forcings. So how they all come together, that alphabet soup graphic, how they play against one another gets to be a challenge. Similarly, there are correlations on the impacts of the other climate alphabets, the PDO, the AMO, so forth and so on. So like I said, roughly 70% of El Niños or La Niñas have relatively well-defined impacts. It's those 30% that throw us for a loop. And the perturbations are quite literally infinite. And that's what makes climate prediction even more of a challenge. And if I sound like I'm making up excuses, yeah, kind of, because that's it. There's so much we simply don't know. Negative Pacific decadal oscillation. Now, these two images are the 500 millibar on the left. This is 500 millibar anomaly off the Pacific coast. The very broad red zones represent an area of high pressure in the upper atmosphere. Now, this is December, January, February, average heights in the upper atmosphere. The blue over the northern plains would represent approximately the polar vortex. The reds near the polar region represent a positive North Atlantic oscillation and Arctic oscillation that would drive the colder air in a normal El Nino negative PDO towards the northern plains. This last year, the right-hand image, very subtle shifts in the pattern, with the ridge being a little less amplified and slightly retrograded to the west, more higher pressure over Greenland, all kind of unexpected in the grand climate scheme. So we had a warm, dry winter. The PDO and the Atlantic multi-decadal oscillations all interact with one another. This quadrature map is from the USGS. It's basically a thumbnail of how we look at long-term climate. So we're shifting from kind of a wetter climate into perhaps a drier climate as the PDO and the AMO rotate around one another. And again, these pattern interactions are fairly well understood in how they look, but how they actually respond is still being discovered. Okay, so the other thing now, this graph goes back to 1950. This is the North Atlantic multi-decadal oscillation as viewed from two different slight sectors of the Northern Atlantic. For the last roughly, well, from 1950 to approximately 2010, the North Atlantic was operating in a rather homogeneous manner, which allowed the weather to behave itself, for lack of a better term. In the last decade, you can see on the right-hand side of the screen, the two trend lines have started to diverge and become antithetical of each other. Well, something is happening with the distribution of the thermal balance in the North Atlantic, which has an impact on our weather. What happens in the North Atlantic affects our weather. We'll think of driving down I-29. There's a semi in the right-hand lane, and then here comes old Mark, the old guy driving past the semi 1 mile an hour faster than the truck. You start back in traffic up behind me. Well, that's basically when the Atlantic multi-decadal oscillation is in a certain phase, it plugs the atmosphere up. And so weather systems change the way they move across the globe. These changes that we're seeing in the thermal distribution are not clearly understood as to how they're affecting everything. We have an idea, and in part of it, it's a sampling issue. We only have real consistent data records back over a large area to the 1950s. So for many reasons, the central US experiences drought and wet cycles on a regular basis. The currently accepted premise is an amplification in these processes, larger floods and worsening. Drought is a function of climate change, will happen. The climate change models all suggest warmer and wetter, depending on where you are in the northern plains. Droughts tend to expand rapidly over relatively short time frames, climatologically speaking, and collapse from the outside in. So we're obviously on the front end of this drought, I'm sorry to say. Don't have to dwell on this. The meteorological winter, very warm, very dry. This data from the High Plains Regional Climate Center in Lincoln, Nebraska. The left-hand image is the normal temperature departure. Obviously some areas 6, 8, 10 degrees above normal, and precipitation across large chunks of the plains 10% or less than normal. Obviously we set the stage this winter for what's happening now. As we get into the spring, the same basic picture. Obviously, you don't have to be a rocket scientist to figure out why we're here. I talked about USGS stream flow data. This is a proxy. This image is from this morning. The USGS maintains quite an extensive database of stream flow data compared to normal. And where the drought is obviously most prominent, you see all the reds across the western United States in the Red River Valley. Now, interestingly, there's a fair amount of green showing up on some of the smaller stream gauges within North Dakota and South Dakota. The smaller gauges have a shorter history, so in part they may not properly capture everything, but also some of the local precipitation events that occurred in the James River Valley and northwestern North Dakota. There's a phase lag, obviously, from when moisture hits the ground until it runs off and gets into the river systems. So these kind of indicators are more for the longer term climate. So obviously the Red River Valley, northern Minnesota, which is not showing up as bad in the USDM, these delayed flow maps suggest that the drought will worsen over northern Minnesota as well. We talk about monitoring drought. Everybody's familiar with the USDM. There's also the standardized precipitation evapotranspiration index, which has been around for quite a few years, but is gaining more and more popularity. We talk about where drought is. There's a global image in the upper left-hand corner there, and I've zoomed into Brazil, Africa, and then the Eurasian continent as well to show where some of the drought. Now, the SPEI is based on the Penman-Montaigne estimation of potential evaporation, which is still a pretty good tool. The major difference with respect to it is that the drought monitor, the global drought monitor, uses thorn weight, which is kind of an older version. That's the one I learned at NDSU 500 years ago. So it's a different estimator, and they say Penman-Montaigne is considered superior. So if you can look around online for the SPEI, it's very easy to find. It's kind of a more representative indicator of what's going on with the drought. So there is that. Okay, what we've all been wanting to hear, the outlook for it, don't want to hear, the outlook for the rest of 2021. So what I use ensemble computer modeling as well as statistical analogs to come up with the outlooks. Ensemble modeling has the advantage because it uses enhanced modeling techniques that have been developed. The European model, the Japanese model, the American climate forecast system, they all come together, and there's many other models that you typically don't see online. So they have an increased confidence in predicting climate. There's general agreement, obviously, to the warmer start of the growing season, and that's where we are. The models picked up on that. Now, neutral precipitation, this is going back early on. The neutral precipitation statement might have slowed the development of the drought. Obviously, the models missed on that. To take a step back, the models use a fairly large scale grid, and so they don't do very well in capturing precipitation, especially convective events. So when you get an event such as the excessive rainfall in the Williston area a couple of weeks back, or the heavy rains in the Jamestown area, I think back in June, the models, the climate models can't see those. So when we're looking at outlooks, they do well on temperature, but they kind of schmooze over the precipitation. And so these are from the National Weather Service Climate Prediction Center. And again, just an image of the sea surface definitions. Wanted to quickly throw in, and actually I think this slide is meant to show some of the predictive tools that we have from the Climate Prediction Center that shows very warm conditions over the western US with the drought conditions from the Four Corners area into the United States, the northern plains. This is the 3-month outlook for August, September, October. So kind of looking forward ahead, the warm and dry. During a El Nino, which is still, a La Nina, which is still typically going on classically, it kind of matches up the historical analogs, the image in the lower right-hand corner for the same time period, broadly the same type of a deal. So just as a sneak peek, as we get into August, September, and October, we're still looking to stay warm and generally dry. Now, here are the ensembles for August. Unfortunately, the bullseye of the warmest temperatures over North Dakota into southern Manitoba, southern Saskatchewan, back into northeast Montana. That's on the left-hand side. The right-hand side is the precipitation rate, which is a proxy for average precipitation, a large departure in the negative. So unfortunately, hot and dry as we go through August. I wish I had better news September and October. Large area of high pressure. Now there's, looking to the west, the left-hand image, you'll see the very large red blob over the northern Pacific. That is a reflection of the extremely warm water over the north central Pacific as a part of this Pacific decadal oscillation that typically generates a trough of low pressure in the western United States and brings us stormy weather. This season, it hasn't happened, and it's one of those deals where we're trying to analyze what else in the atmosphere. Part of it is the Atlantic multi-decadal oscillation. Ewan's going too slow to pass that semi, backing up the flow in the atmosphere, has caused a fundamental shift. We know that, but it's the why. It's getting to the actual why did that happen. So how can we use it to predict it? The climate models seem to be picking up on that. Getting into October, continued very warm over much of the northern half of the country. The precipitation, again, the model starts to back off as we get into fall. And typically in fall, we tend to have dry weather in La Nina during the setup, and it typically switches to wet once you get somewhere in the November, December timeframe. So since this covers the period of October, it may not be picking it up right away. Now in November, the computer models are still warm, but they start to hint at a little green. At least much of the brown and the red has disappeared off our area. So we may start to see some more precipitation events getting into fall, which would be a little more La Nina-esque. So unfortunately, it's going to be hot and dry into the fall. Beginning of the winter looks like we might to see a shift. Temperatures remain above normal into December, and this, I believe, is as far as the ensembles go. A little bit of a hint of wetting showing up in the Pacific Northwest and eking its way out into the plains. That is very much a strong La Nina signal. So we'll see if patterns can shift. There's a weakness that is shown up in the temperature pattern over the Pac Northwest and in the Eastern Pacific, which may be indicative of more troughing starting to develop finally. The models are seeing that. Whether it's legitimate or not, unfortunately, we'll have to watch ahead. South America, now these are from the International Research Institute. They're the same type of computer models. They're ensembles. So basically for this is August, September, October into November, showing very warm weather across large sections of South America as we're in August, with the area decreasing somewhat and shifting south as we get into November. Precipitation, fairly wet across Brazil. That looks like that's going to be kind of the main pattern, according to the IRI's forecast models. And these tend to do fairly well, like the ensembles. So what impact that'll have with agriculture as they get into their growing season, their summer as we head into our winter, something to consider. Australia, as I think most of us know, Australia had been in a massive, serious drought for quite a long time. They've been coming out of it. The temperature patterns are forecast to be a little more tolerable with more precipitation in August and a little warmer September, more neutral in October and November, with generally wetter precipitation patterns for Australia. So their long-term drought seems to be over and is heading in the opposite direction. Is there a correlation between the Southern Hemisphere and the Northern Hemisphere droughts? Well, again, that's something we're looking at because we used to believe that weather didn't cross the equator. Well, we found out how wrong we were. So we've understood for quite a long time that the weather does cross the equator. So what happens in the Southern Hemisphere does have a direct impact, lag in the Northern Hemisphere. So something to consider as we move forward. For Asia, the IRI outlooks only go through October. Basically heat across large parts of the Russian region, northern China. China looks like quite warm getting into October. And precipitation-wise, there are no real well-defined signals across the mainland areas of the Eurasian continent right now. So again, these outlooks are used for planning purposes only, and more information can be provided as needed. Okay, so the climate prediction outlooks based on upper atmosphere circulations in the Pacific. This is just another example. These are canonical analogs that tend to do fairly well. They would suggest, interestingly enough, a July, August, September cool spot in the northern plains. We've kind of thrown that out, knowing that these canonical analyses are missing what is actually happening in the atmosphere, but it's another tool. I mean, it would be nice if the cooling in the CA analogs actually showed up, but sadly, I don't think that's going to be the case. And precipitation wise, the CAs are showing drier weather, generally speaking, over the next several periods. So it doesn't look like these at least agree, unfortunately, that the precipitation will stay on the low side of normal. Just a quick January, February, March, during La Nina, we tend to have relatively normal to colder than normal temperatures over the northern plains, extremes, and precipitation tends to be neutral, heading towards wet. The lower two graphics, those are the top two graphics by climate division. The lower graphics are from the Climate Prediction Center, and they tend to be a little more neutral, showing excessive precipitation, perhaps in the mid-Mississippi Valley and the portions of the Ohio Valley, with warmer weather along the Gulf Coast region, which is a strong La Nina signal. We tend to be colder. The Gulf Coast tends to be warmer during La Nina. So these are the current CPC outlooks looking into the late fall into the early winter and perhaps next year. Quickly, some of my local analogs, which do tend to reflect. So this is for July to September on the far left, September to November in the center, and then November to January. Temperature at the top, precipitation at the bottom for the national areas. My analogs also unfortunately support continued above normal temperatures with precipitation. They may be a little more hopeful in bringing in some late season, early winter precipitation, similar to what some of the ensemble models might be suggesting. My temperature predictions are a little warmer than the ensemble. So I guess that would be my main picture to go with. And then this is just some analogs to look at that are reanalysis data, looking at individual years, July to September of 8. This was in 2009, which were atmospherically speaking, the 2008-2009 year is something that really came through strongly in the analogs about how the atmosphere is currently behaving itself. And so it does indicate cooling getting into November and January, even though right now the main analogs and the computer models do not suggest as much cooling getting into the winter. It is interesting that the years that are most specific to the current ocean atmospheric patterns do suggest that. So it's something to watch, but I would have to say that the dominant forcing is still going to be warm. So drought conditions continue, intensify across the northwest half of the country into Canada through the fall. The southeastern half should experience wetter. Significant variances in the outlook develop moving into the late fall because of these atmospheric signals as they start to break down, which typically happens going from summer to winter. So long-term trends and very low frequency models suggest the drought, milder and drier core winter, historical analogs, and post-1970s trends. 1950s, 1970s, there are two big shifts in the atmosphere I didn't talk about for time's sake, support warmer than normal in recent years. And until we see this relaxation of the powerful Pacific Decadal Oscillation, the massive warm pool in the north central Pacific, I really don't think we're going to see a whole lot of typical ENSO forcing. The La Nina would want to make us cooler and wetter in the winter. I don't think, unfortunately, it's going to happen again. Using history as a guide, the ongoing drought cycle could last several years with the variances in precipitation. The most interesting thing about droughts, at least within the Red River Valley region, typically the first and second years tend to be the worst, then they get beaten down from the outside in as time goes on. So I'm kind of hoping history repeats itself, that we make it through this year and start to see some relaxation, maybe as early as next year. We'll have to see how the climate signals all pan out. One quick slide on agricultural tools of interest. Many of you may know about these. This is from useful to usable. It's a tool that was developed on a High Plains Regional Climate Center down in Lincoln, Nebraska. It's just a way of looking at different crop yields and trends. It's a wide variety of information. One graphic in the lower left-hand corner that shows your average or climatological average temperatures maybe cumulative degree days, things like this, or average max, and there's a way of looking at different data sets. So it might be something to look into, and they have weather stations all through the plains. So the U2U crop tool is something they want us in the Weather Ready Nation world to make sure that the ag world looks, and they want feedback. If you find this tool, hprccunl.edu agroclimate, the URL is up there in the upper left. If you use this tool and find it usable, the folks at Lincoln want to hear. They want to know what can be done to make the tool better. So they really appreciate it. Just a different view of data, how we look at stuff through the XMASIS and the U2 tube. The graphic I'll end with is the American Global Ensemble Forecast System precipitation for the next 16 days. It would basically give us between 1/4.5 to maybe 3/4 of an inch over the next 2 weeks. The model has typically been a little too robust in its precipitation forecast, so I'm not overly optimistic. I wish I were, but it's going to be dry. So unfortunately, we're at the front end of what I think is a pretty significant drought period. So thank you for your patience and letting me ramble on. I know I went through a lot of stuff in short order, but that way, you know, I'm around for questions. I know it's 11:30, so I will shut up.
Well, I have to apologize to everyone. I was so excited to talk about weather that I skipped the break we were supposed to have before you, Mark. So apologize if I caught you by surprise there. But with that, we appreciate your presentation. We wish you had better news. So I'm looking through again the chat and the Q&A function for any questions. And at this point, as Mark pointed out, we're wrapping up our program here, and we do still have some of our panelists on. So if you have any questions for any of the panelists, we'll kind of do a last call for those to go into the chat or Q&A functions. We'll keep an eye on these here. We do have a question. It says, do you expect this dryness? I know you talked about, Mark, how you could see 1 to 2 years of this drought. Do you think we're going to see this in the 2022 crop as well?
Unfortunately, yeah, just again, using analogs and what computer models are available. And most of the ensemble models only go out roughly 6 months. So really not far enough into the future to get an idea of next year. But the analogs that I use suggest this being, again, kind of a multi-decadal drought cycle. So I'm afraid we're on the front end of several years that will kind of offset what the long-term trend of weather has been.
Sure. Any other questions for any of our panelists? I'm not seeing anything. I'll keep an eye on it here, but I'll just start to close this out. If I see something come through, I'll stop. But I just want to thank everyone for being with us today, with a special thanks to our panelists for all of their input and the information that they shared. So I appreciate the questions and the discussion that everyone contributed to today. Do remember that today's seminar was funded by your soybean checkoff dollars. So happy to see all of you tuning in and taking advantage of that. So with that, I will close the session. I don't see any other questions coming through. And remember, this is being recorded, and so we will send out a recording link along with a survey following as well. So with that, I wish everyone a successful growing season. I hope we get some rain coming our way, and just have a great day, everybody.